The global economy is clearly slowing, and that's the backdrop.
It's the global labor market that's really holding up still.
The key surprise of this year, right, has been the resilience of the labor market.
We have had a very steady pace in terms of overall spending, and the labor market is great.
There's definitely a chance of a replay of headline inflation volatility next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK taking a long weekend. He'll be back in a couple of days' time. Equity futures down 0.8% on the S&P 500. Bramo, it's the final stretch of 2022.
And it's getting gloomier, and yet it's really interesting that we're not necessarily seeing the gloom translate into higher yields because of inflation going forward. It is a lower yield, lower stocks kind of morning. The idea that perhaps this is risk on, and what's bad news is really bad news.
Should we go through the calendar? December 2nd payrolls this Friday, then December 13th CPI in America, the day after the Federal Reserve. I think we hear from Chairman Powell on Wednesday. And looking out to 2023, we want to know, I guess, two things. One, show me what the Fed's going to do, and two, tell me what China's going to do. And the China question gets a little bit more complicated after the events of the weekend.
I was going to say China looming really front and center with all these outlooks, how much get ripped up right now based on what happens in China right now. The protests really questioning how long zero COVID can last, given the fact that Xi Jinping is trying to tamp down protests in a way that some people say they have not seen potentially since Tiananmen Square.
You're looking at the same thing I'm looking at in the market off the back of this. Equity's down, and I get it. We get it. You sell risk and you ask questions later. Crude in the 70s, in the low 70s off the back of all of this. Your thoughts on what's happening with the price action off the back of the story of the weekend?
I reject it.
You reject it. Why do you reject it?
I just don't understand why what's going on in China means lower crude, because ostensibly more protests and the speculation of a faster end to zero COVID, because how does Xi Jinping deal with this? This is social unrest and economic pain at a time where they have to move away from zero COVID at some point. If they move away from this sooner, doesn't that mean that crude goes up? Doesn't that mean that the bid goes up? Doesn't that mean that globally the inflation?
If they move away from this sooner, if they do.
But if they don't, how do they sustain this? Do they just tamp down? Do they put iron doors on all of the apartment buildings? How do they tamp down on this unless these protests aren't real? But from all of the imagery, it seems like it's spreading in a significant way.
The range on crude we've seen over the last month, in the month of November alone, we've had a $20 range on WTI crude from the low 90s to the low 70s. The broader price action looks like this morning. Good morning to you all. Equity futures on the S&P 500, negative and down 0.8%. Yields doing their thing on a 10-year. We look like this on a 10-year right now, basically unchanged, 367.93. Talking about the range of November, the range of the year on euro dollar, back to 104.85 on euro dollar, positive 0.9%. So a stronger euro in the mix. I'll talk about the ECB speak a little bit later. Bramo's going to run you through that and the Fed speak in just a moment. Crude 73.93. There's the move, Bramo. A move of more than 3% lower on the session.
And somebody else who's probably a lot smarter than I can explain it other than just rejecting it outright. And we look forward to them coming on and doing that. Today, what we're looking at when you talk about ECB speak, Christine Lagarde is addressing the European Parliament at 9 a.m. I'm very curious to hear how determined she is to raise rates and keep rates higher in the face of the highest inflation since the Eurozone was created, above 10%. If you take a look at the latest reads, European ECB Governing Council member Klaus Knot said earlier today that the idea of us being over-tightening or over-restrictive at this point is a bit of a joke. So just to give you a sense of where others are. Today, New York Fed President John Williams speaking at the Economic Club of New York. How much does he really push back against some of the recent lift that we've seen in stocks? We're not seeing it today. But just the Financial Conditions Index, which I know Tom looks at a lot, it's weaker than it was at some of the weaker points back in October and even earlier in 2018 and 2017. So how much do we end up with this? And today is Cyber Monday. Are you buying stuff?
What difference does it make? Cyber Monday, Black Friday. Doesn't it all happen at the same time anyway?
That's the point.
What's special about today?
That's the point. And so are people doing less of it because they're preloading and backloading and everything loading because it isn't really that different from any other day? Are people not buying it? We've seen Amazon shares down more than 40% year to date. And today, on this big day of shopping, they're still down. So I'm just giving you the sense. I agree with you.
We on the same page? Good. Apple's down about 1.9% in the pre-market.
Yeah.
Our story this morning, the lead paragraph on Apple, turmoil at Apple's key manufacturing hub, likely to result in a production shortfall of close to 6 million iPhone Pro units this year. Lisa, that's according to our reporting this morning.
And Apple has been the one tech company that's been immune to a lot of the pressures felt at some of the other companies. They haven't seen the same kinds of layoffs. They haven't seen the same kinds of margin compression. They still have a ton of cash. Will this change that narrative?
We'll pick up on that story a little bit later with Dan Ives of Wedbush later on in the programme. Joining us now is Brian Weinstein, the head of fixed income at Morgan Stanley Investment Management. Brian, I want to start with the events, the unrest in China over the weekend, and walk me through how you and the team are thinking about it this Monday morning.
I think it's just part of the broader story of more economic turmoil, uncertainty, and slowdown. And Lisa, we hear you that it's certainly possible that the zero COVID ends early, and that would be a game changer. But it's just as possible that the clampdown comes, uncertainty stays, supply line problems rebuild, and it just causes more economic slowdown out there. So it's a tough one to figure out on a minute by minute basis. But for now, the zero COVID seems to be here, and it seems to be part of. You look at yields, right? The yields are falling. Economic growth is slowing around the world.
But Brian, on the flip side, either way, whether they keep COVID zero and it causes supply chain kinks to last for longer, or they release it and it causes demand to go up, either way is inflationary, no?
It does seem so. Again, if you look at if you look at where we price inflation to go to back to the twos, it's very optimistic, right? There's many reasons to believe inflation will stay stickier, makes the Fed's job harder, makes the curve stay unbelievably flat and maybe get flatter. Yes, we would agree with that. It's hard to see inflation pressures easing off completely, though I do think the direction of travel the next 3 to 6 months will be lower.
But to that point, Brian, the move in 10-year yields has been notable. Long-term yields have been bid dramatically over the past couple of weeks. This has been the one consensus trade, and perhaps people getting ahead of the first half of next year and doing it all now. Has it gotten over its skis considering how long inflation could remain higher, how determined central banks around the world are to be restrictive for a sustained period of time?
Maybe. I've been impressed with how far we've come. And we went from a period when 10-year notes were 450, where it felt like nobody would ever want duration again. And here we are at 370, and we feel okay. I think this is the stage where if we got a little bit of weak economic data, you could have another leg to this rally, call it 325 on 10-year notes, get the curve really inverted, minus 100, maybe a little bit more. Long term, do I think we're having a big fixed income rally? No, I think the income is great. You don't want to chase too much, but I do think you could have another leg here, given that data could get weaker.
If you think we could get another leg lower in yields, does that mean you think maybe risk has overdone it here, Brian?
I think so. I think that's the trade here. I think all year we had duration leading risk assets lower. This rally, duration did better, but risk assets did well too. If we rally again, I think it's because risk comes off. We accept the fact that next year is not going to be easy, that earnings could be worse than we think, that uncertainty is high, and that duration actually is still cheap relative to risk given what happened this year.
I'm looking right now at high-yield bond spreads, just to build on what John was talking about. They are the lowest going back to August. I mean, talk about the rally that we've seen as people pour into risk, even though the lower leg in yields that you talk about, Brian, really has to do with weakness. Could we see a material pickup in defaults, or is it just a positioning? Is it just a technical widening in spreads that you're looking for?
I think defaults are coming. I don't know that we're going to see that into the next 2 or 3 months. It takes a little bit longer, right? We haven't seen the impact of higher mortgage rates. We haven't seen people have to refinance, a lot of debt yet. So I think defaults are coming, but I think it's a bit more technical. I just think high yield looked great with a 9% return handle on it. When you lower it by a good 100 basis points, 200 basis points, the higher quality assets just look better. So I think the default story is out there. I think the earnings story is out there, but I think it's a bit more technical in the next couple months. Weaker growth. Risk has done too well. People have chased it, and we have to reset.
You said defaults are coming, Brian, but this is one big question mark. How much? Are we going back to sort of a pretty high default cycle, or is it really the consensus that you buy into as well, that it's going to be a relatively low kind of level of default for a longer period of time?
I think the lens people always jump to is 08. And I don't think that's the story here, right? I do think balance sheets are okay. I do think there are certainly buckets of consumers that are doing well, or baskets of consumers that are doing well. And so I think we're going to go back up and probably scare the market a bit, go higher than maybe average. But I don't think it might be a longer drawn out default cycle, but I don't think we have massive default spikes in Armageddon. That's not what's in play here.
I've got to put you on the spot for 23. Is your working assumption COVID zero in China for 2023, Brian?
Such a good question. My working assumption had been before the weekend, yes, and I haven't maybe got enough information to redo it. They definitely want to stick with it. I'm a little less certain now, but I'd still stick with yes.
Brian Weinstein of Morgan Stanley, thank you, sir. As always, I think for a lot of people, if you're sitting around the table wondering whether to press send on your outlook for 2023, I think it's an argument after the events of the weekend, Lisa, maybe to wait a week or maybe wait a couple of weeks.
I would agree with you, except that in a week time, and especially after we get the next inflation report, the next jobs report, you'll be saying that again. I mean, at what point does you have to rewrite it every 10 days just simply because of how quickly things are moving and the degree of uncertainty?
Just wait until December 15th, the day after the Fed. Just wait until at least then. Does it really make sense until then?
If they waited until after December 15th, we'd all be mocking them. I mean, let's be honest. We'd be saying, you know, oh, so they're going to wait until the last very second.
I promise. You know, okay. No, I think it makes perfect sense. If you want to wait until December 15th, you get no criticism from me. I don't know what that's worth to you. If it's worth something, if it is, you can wait.
To them.
No criticism whatsoever.
No, I think that you're right. I think that there's so many moving pieces and there's so many key pieces that are going to be determined heading into the year end, where there's typically thin liquidity and other technical issues, which I wonder how much that could set up for a pretty interesting kind of combustible mix.
Brian Weinstein thinks risk has overdone it. We've had a 20% move on the Euro Stoxx 50. Have you seen that?
Yeah.
Off the lows of September, a 20% move in Europe.
How much is that because of not as cold a winter as people thought, stockpiles of energy, of natural gas being higher than expected? And did you see the dollar? I mean, how much is that fueling it too? The dollar is the weakest going back months. I mean, how much can you honestly get this kind of ongoing rally, or is this sort of it in terms of just a repositioning?
European equities bottom September 29th, the dollar top 2 days before that. The story's there for all to see. And
you heard all of this from people talking about this, that basically where is the value? They go into Europe. I do wonder, though, the European story, how closely is it tied to China? And this is why China is such a pivotal piece. And it's good that you asked Brian that, because how much does a reopening of China help Europe versus hurt Europe by taking natural gas demand out and actually really pressuring on that side of things?
Big question. How was the World Cup banter whilst I was away?
I was dreadful. Tom did his best, but I was pretty dreadful. He did his best. I will say I actually watched the World Cup all weekend. It was great.
Wonderful.
Really good soccer.
I'm pleased you're engaged. That's great.
Did you hear about that? The U.S. versus England?
I did,
It's called soccer.
That's fine. That's fine. I'm pleased that America's engaged with the world's sport.
What are you, a diplomat?
So diplomatic. Yeah. No one
endlessly
thinks I'm diplomatic. Futures on the S&P down 0.75% at the next hour. Michael Purvis of Toolback, and looking forward to that conversation. Dan Ives of Wedbush is coming up later as well on Apple. And next on this programme, we'll catch up with Enda Curran in Hong Kong on the latest in China. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. In China, protests against COVID restrictions are spreading. Citizens took to the streets and university campuses and vented their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai, where some called on President Xi Jinping to step down. That's a level of defiance unheard of since Xi took power a decade ago. The price of oil has fallen to its lowest level in almost a year. The protests in China clouded the outlook for energy demand. West Texas Intermediate fell below $74 a barrel following 3 weeks of losses. The unrest helped the dollar as a haven, which made raw materials less attractive. Retailers in the U.S. saw modest growth over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts lured in shoppers that were looking for a break from inflation. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
It's clear to me that Xi cannot tolerate any protests. So there will be a very tough crackdown on any protesters. More people will be arrested, and they will probably go further in terms of control.
Waiting to see what the response will be. That was Mark Mobius there, Mobius Capital Partners founding partner on Bloomberg TV a little bit earlier on. From New York this morning, good morning. Equities are lower on the S&P 500 off the back of some of that unrest in China. We're down about 0.75% on the S&P. Euro stronger, 104.88. We're positive there by 0.9%, creeping closer and closer to 105. Yield's not doing much on a 10-year, 368.49. Later this week, it's payrolls on Friday. Then on Wednesday, you hear from Chairman Powell. The events of the weekend just dominated by concerns about unrest in China. How's this for colour, Lisa? CCTV in China appears to be cutting footage of maskless World Cup football fans in Qatar, cutting away from the scenes of maskless fans at the World Cup.
How much is that just showing what we're seeing and how significant it is? And the fact that this is actually being aired, that to me is notable. This is actually getting out there. The politicians have to respond.
Let's see how they respond. Enda Curran joins us now, the Bloomberg Chief Asia Economics Correspondent. Enda, I want to start here and broad and help us if you can. What marks the difference here between what we've seen over the weekend and what we've seen in years gone by?
So these are unprecedented, John, in recent years because of the number of cities that they're occurring in at the same time, their breadth, and the fact that they are protests against government policy, a uniform protest against government policy. Now, sporadic protests in the past in China have not been unusual. They've been against perhaps a local environmental policy, the location perhaps of a landfill site, for example. These kind of things. These protests come and go, but these are unusual because you're talking about the far west of China. You're talking about Beijing, Shanghai, Guangzhou. Next door to us here tonight. All of these over the weekend have had protests, all pushing back against the Communist Party, very explicit commentary against President Xi Jinping, and it speaks to the level of frustration, of course, and fatigue on the ground. We often talk on this programme, on your programme, about how do we know what a sentiment in China is like. Well, now we're getting a real glimpse of it via social media. Obviously, it's being heavily censored, but enough is leaking out to let the rest of the world know that there is a lot of fatigue and frustration in China right now.
And when you talk about how a lot of it's being censored, I think of those blank sheets of paper that they're holding up to signify that they are being censored. Others sometimes having the circle with the exclamation point in it to signal that something has been retracted or isn't available. How much is it unusual that this is getting out in the way that it is, even though, yes, it is significant, but normally wouldn't the Communist Party crack down more significantly?
Well, it's interesting. So two things are going on. On the ground, some experts I've heard say are making the point that so far the government are allowing these protests to some extent, that they're allowing these people to vent clearly by allowing these gatherings of maybe hundreds or thousands, depending on which city you're talking about. So there's an element of that going on. Social media, though, is being heavily controlled, and I think the fact that so much is leaking through speaks to the volume of protests that's being aired on social media and the volume of discontent. So clearly the government is struggling to keep a lid on what is leaking out. But the big question, though, is what will the response be going forward? A lot of experts are saying, of course, there's going to be government response, likely through the police, through the typical response of mass arrests and crackdown on these protests. And will that be enough to keep a lid on it? I think that's the big question going forward. The government's unlikely to materially pivot on COVID just in response to the protesters, but there is a view that this might accelerate the path that they're on to get out of this position that they're in, which is going to be clearly a very complicated and I think damaging path for the economy in China.
And what's the main holding point for China to not go and say goodbye to the zero COVID policy?
A public health disaster remains number one. I mean, obviously there have been some political bragging rights. The Communist Party and President Xi Jinping has enjoyed the point that look how we've handled COVID versus the Western world. But leave aside the politics of it, several experts make the point that China's hospital network is not up to what's needed to deal with a mass outbreak of Omicron. And Omicron, of course, is what the big game changer in all of this. And then you have the Achilles heel, which is the vaccine coverage of the elderly. Now, China's homegrown vaccines have been shown to be perfectly effective and safe, not as effective as mRNA, but effective. But the big problem is the coverage of the elderly in terms of getting their vaccine and getting their booster shots. We're going obviously into those deep winter months now. This is a key vulnerability for the Chinese economy, and this is what the biggest concern is, I think, for most people looking in on China. How are they going to get that right, and what will it mean for the hospital network?
Andrew, it's a mystery to me as to why we had stronger vaccine mandates in the West and not in China. And it's a mystery to other people as well. And why is that the case?
It's a very fair question, John. A lot of people do raise the point with the political system and the control that China has in place. Why haven't they been targeting the elderly? There is a response that it's perfectly rational that if you live in a country where you don't have COVID, why would you get vaccinated? But of course, the Western world or the outside world would say, ultimately, COVID zero is unsustainable. There will always be a leak. And Hong Kong is exhibit A for that. It's a very same set of circumstances. We had 2 years without COVID, but we had an elderly population that were not vaccinated. There were plenty of warnings. This is not sustainable. Ultimately, the disease will arrive. It did arrive. It spread rapidly this year, as we know, and we had very serious fatality rate among the elderly. And a lot of people are pointing to Hong Kong as a key warning for the risks that China is now facing.
And wonderful to catch up with you, sir. Thanks for staying late into the evening for us out of Hong Kong. Enda Karen there. Bramo, we're not the only people asking that question. Many people just think it's absolutely bizarre. Totally bizarre.
If the public health concern is the main concern for why you're not going to end COVID zero, why not expedite some kind of vaccination progress in the weakest links and the people who are the most vulnerable?
It's not for me to say what they should do from a policy response. But sitting here, I'm just saying it's strange that we saw a stronger push for vaccine mandates in the West than what we're seeing in China. That just seems very, very odd.
There are a lot of questions, and I will be delicate here, about the consistency of the public health concerns with COVID zero and how it's being enforced. And that is probably underpinning some of these protests, especially in light of the footage of fires and people and firefighters not being able to get to the citizens because of the iron gates put around their communities to enforce COVID zero. It is a question around public health that cannot be answered when it is so inconsistent. And it has been inconsistent all over the world, don't get me wrong.
Sure.
But China has been the outlier in terms of how long it takes until they can really exit this.
One US official outspoken on all of this over the weekend, the president's response coordinator for the pandemic, speaking on ABC's This Week on Sunday, quote, "It's going to be very, very difficult for China to be able to contain this through their zero COVID strategy." That individual went on to say, "I would recommend that they pursue the strategy, making sure everybody gets vaccinated, particularly the elderly. That, I think, is the path out of the virus. Lockdowns and zero COVID is going to be very difficult to sustain." Let's see if they try to sustain it.
I mean, that's kind of true, right? I mean, it's been proven to be true in terms of it is difficult to sustain. They continue playing whack-a-mole with different outcroppings of COVID. They're going to continue with this. I just wonder how much we're going to end up with a situation where this is positive for the global economy or negative in terms of the inflationary shock.
Futures negative 0.75% on the S&P 500. Coming up next, looking forward to catching up with Dean Kernert, the founder and CEO of Macro Risk Advisors from New York City. Heard on radio, seen on TV. This is Bloomberg. I love the feedback I get on this programme. Johnny boy, I think you need to go Mobius and rock a white suit on air sometime this week. How do you think that's going to work out? A white suit. If TK goes beige and I go white suit, I think that would work.
What color tie would you wear?
With the white suit?
Yeah.
What colour tie do you wear with the white suit?
I think that you would have to...
What does Mobius do?
I think it would have to be like a tan kind of paisley, which I can't imagine at all you're ever wearing. I think that you'd have to be
pleased the camera didn't pick up my face then. Equity futures on the S&P look like this. We're down by about 0.8% on the S&P. On the Nasdaq 100, we're down by 0.9%. On the Russell, the small caps lower by 0.75%. Apple, the stock to watch, is down by about 1.8%. Bramo will talk about that a little bit later. Our reporting this morning is the turmoil at Apple's key manufacturing hub in China likely to result in a production shortfall of close to 6 million iPhone Pro units this year. As I say, we'll pick up on that a little bit later. In the bond market, 2s, 10s and 30s look like this. The 2-year backing away from the highs of the year over the last few weeks. 446.29 on a 2-year, going into Chairman Powell on Wednesday and payrolls on Friday. The 10-year basically unchanged this morning at 368.12. The curve deeply inverted. In the FX market, euro-dollar the standout. Yen strength out there too, so dollar weakness the theme of G10. Euro-dollar right now pushing 105 at 104.87, positive 0.9%. We've talked about the Fed speak. Bramo mentioned the ECB speak, and I think this line, I'm with you, from Klasnot of the Dutch Central Bank. He called any talk of over-tightening at this point, quote, a bit of a joke. Now, the thing that I have with this, Lisa, is that many people don't think it's a joke.
No.
I think it's a very real conversation based on where the growth picture, the backdrop's going to be in Europe going into year end.
And the reason why I think that a lot of people don't view it as a joke is because of something that Torsten Slok of Apollo put out over the past couple of days, where he was talking about recent reports putting only a third of the inflation that we're seeing due to demand side issues. The rest are supply side issues. So if you crimp demand, it doesn't even necessarily affect inflation as much as people previously expected. So in other words, if you tighten all you want, it could affect a third of the inflationary picture. It isn't the main input, which is the reason why some people say perhaps you're using a blunt instrument for a very different problem this time around. So
Philip Lane of the ECB has written extensively on this, and he did so recently in a speech. What's interesting, though, even though he comes to the same conclusion, ultimately, he thinks the risk is inflation expectations and you've got to do something about it, so you've got to keep on hiking. I'm pleased you brought up Torsten Slok, because over the last few weeks, he's made a very, very important point, comparing Europe to, say, the United States, and it's the sequencing of the downturn. The idea being that in Europe, you're getting a downturn in the economy before you get a peak in inflation. And in America, maybe you're getting a peak in inflation before you get the downturn in the economy. And clearly, the latter is far more favourable than the former for a policymaker right now. And I think for the Europeans, for the ECB, tremendously difficult position to be in, to be hiking interest rates before seeing a peak in inflation. They're witnessing this economy roll over.
They're between a rock and a hard place. I don't envy the ECB. I don't think that anybody does. They don't have the tools to really respond to something that's an energy-driven crisis, that's really a supply-driven crisis. It isn't necessarily the same kind of demand, although there is that as well, partly coming from the U.S. I don't know how they get themselves out of this, but I want to hear from Christine Lagarde, because is she going to basically reiterate what Klaus Knott said, which is, we're not even close. We're going to keep hiking.
Does Lagarde speak every week? It feels that way.
Well, I mean, she's got to keep up with the Fed.
Every single week. We don't hear from Chairman Powell that often.
Yeah, but he's trying. He's speaking Wednesday, so we'll see.
We'll hear from him later. You've been diplomatic this morning. Good for you.
Anytime.
Dean Kernet, founder and CEO of Macro Risk Advisors. Tom would have gone for that.
Yeah, he would.
You know,
yeah.
He would have had a good dig.
Uh-huh.
Dean, thanks for being with us, sir. What do you make of the rally we've seen over the last month? And after we heard from Brian Weinstein and Morgan Stanley about 20 minutes ago, he turned around to us and said he'd fade this. He thinks we've overdone it. Do you agree?
I would probably be more in that camp than the other camp. But just go back to CPI day, a 5.4% move in the S&P. It's sort of the upshock heard around the world. And if you just look at the import of that day and just look at all of the cross-asset indicators, whether it's the decline in rates, the decline in volatility, the significant decline in the dollar, I think the good news for that day is that we moved away from the cliff. We were headed towards a cliff event, specifically with respect to how tight the dollar was imposing itself on the sort of system of pricing of risks. So we moved away. The last 10 days in the S&P have been super quiet, and we're kind of in this holding pattern right now. And what I mean by that is we're obviously waiting for Powell on Wednesday, and then we've got this twin terror events, especially if you're short volatility on December 13th and 14th. I can't remember a time when the CPI and FOMC were on top of each other like this, just given how substantial these days are. So, John, as you know, we focus on volatility at Macro Risk Advisors. The VIX is down around 20. I'd like to say we're pretty close to a floor in that. I don't know that it's going to spike tomorrow, but I think we've settled into a level where the folks that are being asked to sell volatility are going to have a harder time letting it go at this price. There's not a lot of room for error to down around 20 in the VIX from here.
Well, you are really famous for saying that transitory is a new subprime is contained. And you said that on this program months ago. Are we there yet when it comes to rolling over inflation? And even if we do see some kind of spike up in volatility, it isn't going to cause some sort of meltdown because we are starting to peak out and roll over.
Yeah, we're all subject to the data. And I think that at least recently, the data has been cooperative in a way that you might be able to start. You can kind of see the path from here. There's so much market conversation around December is 50. We're sort of locked in on that. That's a deceleration from 75. That's a big deal. Even just being able to get the Fed to 50, and then maybe you do a couple of 25s in the early part. And that policy rate, the forward policy rate, peaks as early as March. So you can kind of see forward here. And a lot of that is that if you won't hear this from the Republicans because they'll be stuck on year over year, as they should be in terms of the political fight. But over the last 3 months, your inflation's sort of annualizing 3.5%. So you're getting closer. I think the question then is going to become, and again, this is why this is going to just take so long is if you're in the 3.5% zone, are you really committed to getting to 2? And Lisa, as you were referring to, if higher rates are your instrument to get you to 2, and getting to 2 is really less about demand, it's more about supply that higher rates doesn't affect, well, then you really might be, putting a lot of downward pressure on risk assets. So it's going to be a long period of time here. I certainly think you're supposed to watch the yield curve inverted by, take your pick 75 on 2s, 10s. But if you look at the forward policy rate versus where 10s are now, you could invert out to March by 125 basis points. That's pretty deeply inverted. And I think it's the market telling you something that the Fed may be vulnerable to going too far here.
Brian Weinstein agreed with you. He basically was talking about a similar type of inversion and sees the potential for 10-year Treasury yields to go to 3.25% at some point in this next leg of a rally. Have we reached a pivot point, an inflection point, where yields can go lower and stocks can go lower, where bad news is bad news, and we're really entering that phase in a more sustained way?
Yeah, I think that's exactly the narrative that I think is applicable here, which is these taper tantrum type episodes where rates are the impetus for stocks falling, higher rates, lower stock prices. That's a correlation we're not used to. I think they typically end with a more classic risk on, risk off, and that is lower rates, lower stock prices. So I personally think that's ultimately where we're going. It's very, very difficult for the Fed to land the plane here successfully, and for risk assets, let's just use the S&P, to do fine from here without the Fed over tightening. So I do think that there's a potential that you'll ultimately see more of this sort of classic stocks down, rates down type of scenario. And look, we're supposed to try to find portfolio additions that are less correlated to risk assets. So what's been correlated? Well, obviously the bond market and the stock market have had almost a record positive correlation. Stocks and the dollar, that correlation has been incredibly strong, in a way that just doesn't lead to favorable diversification. So one of the areas that I think you're supposed to look at, especially as digital gold has blown up, Bitcoin has blown up, is to look at gold itself. Gold and the S&P, they have a strange relationship. They're correlated sometimes. They're recently very correlated because they're both negatively correlated to the dollar. But I do think that there's an opportunity here to, as you build your portfolio out and you try to find those lower correlated items in the portfolio, I think that gold has got the potential to do well in what I think is coming, which is a classic risk off. Stocks down, rates down. That's a scenario where gold can do quite well. And if you look at the options market, the upside calls on gold are quite cheap. That's the implied volatility is as low as it's been since the start of the pandemic. So that's a conversation we're having with clients right now.
Gold up this morning by a third of 1%. Dean, awesome as always. Dean Kernet there of Macro Risk Advisors. That was Dean in the summer of 2021, The transitory is the new subprime is contained. Summer of 21, what a call by him. And many others as well.
So now what do you do, given that you expect it to roll over by perhaps the first quarter of next year or second quarter of next year, which is exactly what he's talking about? All of a sudden, we're in a new inflection point. And we've been talking about how trend following is suddenly shifting and churning, and there isn't this clear trend the way there was for the past few months, because we're entering something new where yields can go lower and stocks can go lower at the same time.
2s, 10s, negative 78. That's kind of crazy, isn't it, to see that number on the screen?
It's even crazier to think that we're going to 100, negative 100, negative 125. And we heard
Brian's right, yeah.
Brian and Dean Kernet, they both agreed on this. I don't see another out, because if you look at the idea of a rally in 10 years, which is the reason why people say this is a safe haven, and you still think that the Fed's going to hold rates at a higher level than where we are right now, it makes sense.
We've solved the white suit dilemma, if you're interested.
I know, I saw that.
Jerry Ad on Twitter. Thank you, Jerry. Just go full on Travolta, black shirt, no tie. That's how you get around this.
Well, I actually did some research also, because I figured that I needed to have a better answer
for you.
What
does Mobius do? What does Mark do?
That's exactly right.
Isn't it a yellow tie?
He does a yellow tie. He also does a bright blue, a light blue tie. I think it's really see rocking that. There's others where he does not wear a tie. I think that you could rock that look. And then there's a black tie, yellow tie. He has all sorts of ties. I think you've got lots of variety.
Google image this.
100%.
I'm not going anywhere near a white suit.
No kidding. I figured, though, I would just, provide a little insight. Other than
it's a hard pass from me. Coming up, and that's not me taking a dick at Mark Mobius, of course. I think his suits are great. Coming up, Ellen Wald, Senior Fellow at the Atlantic Council from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A sense of uncertainty sweeping through Chinese markets as protests against the government and its COVID-0 strategy complicates its path to economic reopening. Goldman Sachs economists said they see a chance of a disorderly COVID-0 exit. Demonstrations across various cities and universities in China were fueled by a deadly high-rise apartment fire in Urumqi. Now that some blame that virus restrictions hampered rescue efforts there. Republicans say they'll demand greater oversight of U.S. military aid to Ukraine when they take over the House. Representative Michael McCall told ABC News that there will be more transparency and accountability. McCall also said he supports sending Ukraine long-range weapons to defend against Russia. Federal Reserve Chair Jerome Powell is expected this week to set the stage for slowing interest rate hikes. At the same time, he'll remind Americans that the fight against inflation will run into 2023. Powell will make a speech on Wednesday, one of the last from policymakers before the Fed's meeting December 13th and 14th. And after cutting thousands of jobs, Twitter now hiring. That's according to slides from a company talk tweeted by owner Elon Musk. The first slide had the words, "We're recruiting," with no further details. The slides also said that new user signups are at an all-time high, averaging over 2 million a day in the second week of November. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
This full reopening, as I mentioned, is to us more of an H2 story. I think in the near term, it seems to be more of a drag on oil than anything.
Christian Muller-Glissman there of Goldman Sachs weighing in on the situation in the commodity market. Live from New York City this morning. Good morning. What a trip it's been through the month of November on crude. The highs of the month in November on WTI came on November 7th. We came close to 94. Since then, we're down by more than 20%. So from the low 90s, Bramo, to the low 70s in what, 3 weeks?
And why? The real question is the why.
Have you got the why?
People saying that perhaps the economy is going to slow down to such an extent that it will reduce demand. Other people speculating that more oil is going to come on. I'm not understanding the why. I just can't get my hands around why.
So let's go to the story of the weekend, and I'll get your thoughts on that as well. So we understand the Biden administration has granted Chevron a license to resume oil production in Venezuela. I think many people saw this coming after US sanctions halted all drilling activities for much of the last 3 years. I think we're all asking the same question. How much of a change is this?
We don't know the answers to that. What we do know is that a lot of Western nations are going around the world figuring out who the less bad players are for them to source some of their fossil fuels, some of their natural gas, who they can rely on over the short term, over the longer term. And those alliances are getting redrawn. The power lines are getting redrawn. How do they shake out? We don't know yet.
Ellen Wald joins us now, Senior Fellow at the Atlantic Council. And I'd love to start there. Just the latest move from this administration for Chevron around the story in Venezuela. What are your thoughts on that? Are we still too light on detail for you to draw too many conclusions?
You know, I do think that we're short on detail here in terms of the Chevron story. So, for example, is this oil that's already on the market just on the black market? Or is production actually going to increase in Venezuela, in which case that could be meaningful for the market, but probably is going to take quite a long time to actually get going because their oil facilities have been in incredible disrepair. I mean, this has been a very, very long problem for them. The interesting thing, though, is we say that, where they're looking for oil producers that are less bad. You know, there are a lot of less bad oil producers in the United States that have the ability to produce more, just they aren't producing more because they don't think that the atmosphere is conducive towards it, and also that they're facing a lot of headwinds from inflation and having trouble getting parts and getting labor and getting equipment, and costs are very high. But there are definitely things the Biden administration could do to encourage those less bad oil producers in our own country.
Ellen, then why are oil prices so low? Is this something that completely is a demand side story that we're seeing play out, or is it just the imagination of a demand side story that is yet to play out?
So I do think that it is somewhat of an imagination of a demand side story, because you do have a situation where I think futures trading is impacting the prices now, and the future of oil is very, very hazy right now. What's interesting, though, is that the fact that prices are kind of low now could actually spur more European utilities to switch from natural gas to oil, and that could then later kind of send a bump into oil prices. So I think that just because we're seeing kind of a lull or a period of lower prices now, we shouldn't expect that that's necessarily going to continue. There's always a tendency to think that what's happening now is what's going to happen for the rest of the winter. And I think that with what we've seen certainly in the past with the incredible volatility here is that we cannot underestimate the effect, and we could see a very, very quick rebound if we're not, careful and paying attention.
Ellen, the big news over the weekend was the social unrest in China, the possibility of perhaps a quicker exit to zero COVID on the heels of protests around the nation. Do you view the unrest that we're seeing over in China as being potentially a logical reason for oil prices to be lower, or would you expect that to actually send oil prices higher because of what it might mean for zero COVID?
Exactly. So I do think that earlier in the week, that China's COVID policies, continued lockdowns, things like that, definitely helped send oil prices lower. So if we're talking about, say, the beginning of last week. And the question is, what do these protests actually mean? I'm not a China expert, but if you do look at China's history, the regime there has not been particularly responsive to protests. They also don't seem to really have a problem with lots of people dying in pursuit of their policies. So just the fact that there are protests in China, I think it means we should pay attention to it, but I wouldn't necessarily put my money on it having a widespread impact or a big change or shift in the Chinese regime's policy particularly quickly.
You are an OPEC expert, so let's build on some of that knowledge if we can. I'm interested in the working assumptions for next year. Is OPEC looking at a 2023 where COVID zero is still implemented by the Chinese government? Is that the working underlying assumption of that organization?
That's a really good question. And I think that I do think that if anyone is going to know first, it's probably going to be Saudi Arabia, because they've got a very close relationship with China, with the Chinese government. They've got lots of oil investments there. Aramco has tons of refineries. They've got long-term contracts for crude. And if anyone is going to have a sense of when China is going to need more crude oil, I do think it would be Saudi Arabia. So if Saudi Arabia is sending signals that they don't think oil demand is going to increase very much over the course of the winter, then that could be an indication of China's COVID policy.
And well, thank you of the Atlantic Council on the latest in the crude market from Venezuela to China, trying to work out 2023. I think at the moment, Lisa, you speak to people on the outlook for next year, they seem to have more confidence about what the Fed will or won't do than they do about what China will or won't do with COVID zero.
What Ellen just said there was fascinating.
Agreed.
And you had a great question. What does OPEC do? And the fact that Saudi Arabia would know first, potentially, because they need to ramp up production if they're going to really cater to what we see over in China if they do reopen, is really telling. And it perhaps puts more importance on the OPEC decision about whether or not to ramp up production based on what they see.
The outlook changes overnight if you get that kind of shift. We've talked a lot about the demand backdrop, crude. We could talk about the supply backdrop, Apple. We're talking about millions of unit shortfall from Apple iPhones going into year end off the back of those shutdowns.
What does that mean in terms of how much prices go up? Or does demand soften enough? And this is what some people would speculate, that perhaps it keeps things a little bit more even if people aren't buying the iPhone as much as they had previously.
So question for Dan Ives of Wedbush, and he's going to join us in the next hour. Permable, some people might say on Apple. I want to understand, is this profit and revenue deferred or profit and revenue lost for a company like Apple? If I want an iPhone and can't get one because I've got a delay, do I just sort of delay that until the next quarter at the start of 23, or do I get a different phone?
Well, that's the issue, is that how long do you delay? And then by the time you delay, they have a new edition out, that all of a sudden it's lost opportunity. It isn't necessarily just simply deferred and delayed. There's also the issue of demand in China, right? I mean, if the lockdowns continue and people have fewer disposable, they have lower disposable incomes in China, that also crimps their demand over there. I mean, Apple's in a tough spot with the reliance on China right now.
Have you seen the new operating system on the iPhone? You seen that? I've got a bigger clock on my phone that I'm not happy about. And if anyone out there knows how to make the digits, the numbers smaller on the clock, I'd love to know. Don't like it. Have you downloaded that?
I haven't downloaded it yet.
It did it automatically.
Yeah, well, mine's fine. My numbers are really good.
No, mine are like the big numbers. Anyway, it's the small things, Bramo, that make a difference to my day.
I'm perfectly aware of this.
Futures down 0.8% from New York. This is Bloomberg.
The global economy is clearly slowing, and that's the backdrop.
It's the global labor market that's really holding up still.
The key surprise of this year, right, has been the resilience of the labor market.
We have had a very steady pace in terms of overall spending, and the labor market is great.
There's definitely a chance of a replay of headline inflation volatility next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The Christmas tree is up.
I know.
The lights are on. It's decorated. It's a beautiful thing.
I know. You're going to just troll Tom the whole morning, aren't you?
And Tom's not with us because he's watching Cameroon-Serbia at home. Live from New York City this morning. Good morning. Good morning. You know I'm not joking.
Yeah.
For our audience worldwide on TV and radio, this is Bloomberg Surveillance with Lisa Abramowicz. I'm Jonathan Ferro. Kicking off a trading week and closing out the month of November potentially on a bit of a down note. Equity futures are down by 7.8% through much of this morning. Last couple of days of November still to come. Bramo, off the back of the events in China over the weekend.
Social unrest on the heels of some of the COVID-0 policies that are getting onerous, and that social images coming out that even fires have been lethal because firefighters couldn't get into the homes because of iron gates. At what point is zero COVID not necessarily preserving public health?
Waiting for the response from Xi Jinping and the government to see if they're going to placate the protesters, or ultimately, are they going to double down on COVID-0?
Can they placate the protesters, given all of the energy that they have put into preserving this policy based on the lack of immunization in the older population? How do they get themselves out of this?
No idea. We've got to talk about the price reaction as well in the face of this. You mentioned crude. I'm with you. We've gone from the low 90s to the low 70s in a couple of weeks. That's a $20 range on crude in the last couple of weeks.
And if the Xi Jinping administration does accelerate a removal of COVID-0, that should be positive for oil because that would increase the demand. So this basically is a bet that this will be increased turmoil, increased clamping down, and a prolonging of zero COVID. That essentially is what the decline in oil prices seems to suggest, although I cannot understand oil.
It's amazing how important this is for the outlook for 2023.
Yeah.
Not just where the Fed's going to go, but where China will be. And ultimately, you can't get a straight answer from anyone. You ask them a very direct question. What's your working assumption for China and COVID-0 in 2023? Is it COVID-0 or do they remove restrictions? Which one is it? And it's kind of like, I don't know after the weekend.
Either way, though, this is one consensus that you can get. Either way, it's going to be inflationary. Either way, if they do preserve COVID-0, that's going to prolong some of the supply chain disruptions. If they release COVID-0, that's going to be more demand for oil prices. Either way, you're going to have some sort of inflationary pressure coming in that's going to keep some of the central banks raising rates and keeping them at that level, which is the reason why I think that we are at an inflection point right now, where bad news is bad news, where yields can go down and stocks can go down. And that is a bit of what Dean Kernet was talking about and what we seem to be seeing this morning.
You thought I was joking about Cameroon-Serbia. 3-3.
I'm
game.
not joking. I watched it all weekend.
Awesome
I'll be
You've
honest.
Been enjoying it.
It's amazing. It's really good.
You know, and how nice it is to see your face light up like that.
Well, I mean,
excited
honestly,
about football.
These are incredible athletes. The athleticism is amazing. The games are riveting. The goals have been tremendous. I mean, it's not just for Charlotte.
Is this disingenuous or not?
No, 100%. I watched it all weekend. It was actually genuinely exciting.
You're on board. I like that. Futures down about 0.75%.
I'm not being sarcastic.
On the S&P.
I really am not.
I don't know.
No, I'm really not. I promise you.
Promise?
I can tell you about like the different kicks that I thought were amazing.
You're making me really happy
the
just
spin
doing this.
On the ball when those corner kicks that really made it in. Oof.
Okay, 367.75 on a 10-year, unchanged in the bond market. In the FX market, euro dollar 104.69. Bramo's going to run you through the ECB speak in just a moment. Euro dollar positive 0.7%. The Dutch central bank governor this morning, I think, making us all laugh, Lisa, turning around and saying any talk of over tightening at this point is a bit of a joke. Is it a bit of a joke?
Let's hear what Christine Lagarde has to say, because she's going to be talking about it. And if it is a bit of a joke, then that means that they have a lot more to go. And that means that they're going to be restrictive into a recession that could already be here. And I do just promise everybody, I actually was being completely honest and sincere about my enjoyment of the World Cup games over the weekend. Today, ECB's Christine Lagarde addressing European Parliament at 9 a.m. I don't think that she's going to be necessarily talking about the World Cup games, but she will be talking about inflation above 10% in the Eurozone and their commitment to getting that down, even if it means being restrictive. She's talked about how recession isn't enough potentially to reduce inflation in and of itself. We also hear from New York Fed President John Williams, who is going to be speaking at the Economic Club of New York. Very curious to how much he pushes back against the recent rally, not today, but over the past few weeks in U.S. stocks, in risk assets more broadly. Is that not what they want to see? Where is the cap where they are comfortable in terms with how tight financial conditions are? We're also getting Cyber Monday today. Thoughts?
Is that your lead up for Cyber Monday? We're getting Cyber Monday thoughts.
Well, it's just
so abrupt.
Honestly, well, I think that this.
Do you actually want my thoughts on Cyber Monday?
Well, I just. You raised this good question. What's different about Cyber Monday than Black Friday,
what's different?
than Happy Tuesday, than Christmas Wednesday? I mean, honestly, every day is a shopping day online, and this is the reason why you haven't necessarily seen some of the crowds in stores.
We're actually showing Amazon stock on Cyber Monday.
Yeah, well, I mean, honestly, it's down, and it's down so hard this year. I mean, it's down more than 40% this year. Shares lower today. Can we generate volume after people buy all the time? Why are you laughing?
Michael Purvis is with us from Toolback. And thoughts, Michael?
On Cyber Monday, no.
Let's get some thoughts on what's happened in China over the weekend.
Sure.
The unrest is serious. Demonstrations that we haven't witnessed on this scale for a long, long time in this country. I've asked the question through much of this morning. The outlook for 2023 hinges not just on what the Fed's going to do, but ultimately what the Chinese government does around COVID-0. What are the working assumptions for you?
Well, I think you said it earlier that, there's a very wide spectrum of non-answers you get on China, and it's because we just don't know. I mean, look, from June, we've been waiting for Xi to sort of accelerate the economy into the Congress, and we just had a few weeks ago. That didn't happen. Then after that, maybe we'll get some, aggressive shift more back towards the sort of the strong GDP trajectory that defined China for the last 20 years. We have not yet gotten that, and instead we're getting people's apartment houses locked down, literally locked down. And so I think that we're entering 2023 when there's just so many unanswerable questions. And China, which has been a pillar of global growth for the last 20 years, kind of underwritten a lot of global growth at various points in time, we just don't know where this is going there. And so that, I think, is going to just create increase sort of the, effectively risk premium across asset classes in many respects, some more than others there. But I think, Lisa, you were talking about this sort of call option on crude oil from Chinese growth that we should get, and maybe this is the catalyst there. But, today that call options is declining in value. I think you have a good point, though. I think we may see this actually as sort of the catalyst to sort of get us a little bit more growth. But again, we're dealing with leadership here in China that is just very unclear about. It's not really articulated anything that the world markets have become sort of accustomed to for so long.
What's your baseline with China right now in COVID-0?
Well, look, I think we're going to get a little bit more of the same. I think we're going to see how these protests roll out. The news flow over the weekend was very disconcerting. One thing that if you look at that I'm a little bit concerned at for a U.S. market point of view is that if you look at things like implied volatilities on the Korean won, which takes a lot of China risk, right? Those have been trading right in line, just as the VIX has rolled over very nicely over the last 6 or 7 weeks since mid-October. There's a little bit of complacency within the EM, the Asia EM currency spectrum, if you will, and so I think we may see that kind of drive a bit of risk off over there, and perhaps a stronger dollar risk-off condition over here into year-end.
Have we priced in the potential for both supply chain disruptions to continue and potentially even higher energy prices enough to get to a place where people have priced that in, not necessarily the growth aspect, but yields can go lower on the long end, even as risk assets continue to sell off in the face of this uncertainty?
Yeah, no, I think that's, wouldn't be my base case here, but I think the supply chain issue is going to be very case specific. We're one of the broader structural trends that we're dealing with over the last couple of years that's going to, I think, really define 23 and 24 is this relocalization, right? But this is, you're still making a lot of iPhones in China, or trying to, right? And so I think we're still in the middle of this bridge, of this transition here, which is going to create a lot of certainly very company-specific earnings stories here.
Well, Apple's one of those company-specific earnings stories, and for Apple, it's a little bit more complex. It's not just the expense involved in rejigging the supply chain. It's the blowback you might get from the consumer base in China. How do you think about that, Michael?
Well, it's a huge market for China, and I think that's, again, it goes back to one of these things where I don't have a crystal ball on what Xi is going to do, and how the supply chains and how the China as a producer, China as a customer is going to play out. All I know is that it's creating questions that are unanswerable, and if that is the case, that's going to put more stress on Apple's investor relations department. It's also going to increase the risk premium for owning Apple shares.
Is risk at the index level then of the S&P 500, or in single names, just relative to the composition of it?
For companies like Apple, and if we see other companies that are very levered to China, as both from a manufacturing and from a demand side, you're going to start seeing that filter into the index level. I think the index story is much more muted because I think the complexion of the index is going to be very different. I mean, I think one of the things, we've seen a lot of transitions this year, obviously, with interest rates and inflation and valuations and at the index level. But I think one of the other stories here is that the quality and quantity of big tech earnings growth over the last 8 years or so has been fantastic. That level of fantasticness is really, I think, starting to be questioned, not just on the micro level of, say, Facebook and Amazon with some of its input costs and so forth, but also just simply the fact that, how often have you heard Google complain about, advertising spend, right? Well, you're starting to see that. So you're starting to see you can't secularly grow forever, right? And so at some point you pick up good old-fashioned GDP sensitivity, and I think you're starting to see that. And that is going to, combined with the micro issues, start really, rolling into, I think, the index level, just given how big a weight they are.
Is the Christmas tree up?
Not yet, no. 2 weeks.
2 weeks' time?
Yes.
Why 2 weeks?
Well, it's because you want it to ripen on the 25th. Properly ripen.
You like to time
it. Yes. You don't want to
go natural.
Yes.
You like, okay.
Yeah.
There we go.
Yeah.
Good
you
to
do
know.
it
Some people like the smell of it.
Yeah.
I'm just saying.
I like the smell of it too.
The smell of it's amazing.
I like walking past them when they're on sale on the street and
someone else
smelling the pine needles.
Yeah, I hear you.
Michael Purvis, a talkback, and great to catch up, sir, as always. Equity futures down by 0.7%. Coming up, Matt Dizok, the head of fixed income strategy for the Chief Investment Office at Maryland Bank of America Private Bank. I laugh every time I read that title.
No.
Can we stop writing the title that way? Just shorten it up. From New York.
Bank of America.
I've told him before. It's ridiculous. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, protests against COVID restrictions are spreading. Citizens took to the streets and university campuses and vented their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai where some called President Xi Jinping to step down. That's a level of defiance unheard of since Xi took power a decade ago. The price of oil has fallen to its lowest level in almost a year. The protests in China clouded the outlook for energy demand. West Texas Intermediate fell below $74 a barrel following 3 weeks of losses. The unrest helped the dollar as a haven, which made raw materials less attractive. Retailers in the U.S. saw modest growth over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic, ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts lured shoppers seeking a break from inflation. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
The Fed needs to back off. it is absolutely clear and has become clear over time. A lot of that inflation is coming from disruptions on the supply side. We have seen a lot of encouraging signs, even in the last consumer price index numbers, that things are turning over. We're seeing things work themselves out.
Claudia Sahm there, the Sahm Consulting founder and former Federal Reserve economist on the Federal Reserve. A lot of people on that page going into the Fed meeting a couple of weeks away. Live from New York is the price action as we look to close out the month of November over the next couple of days, with equities up on a month and down on a session. We're down about 0.7% on the S&P 500. Yields are basically unchanged on a 10-year, 367. Twos versus tens, though. I mean, it is absolutely amazing to see the curve as inverted as it is. And I don't think we should just gloss over it, Lisa. Twos, tens, almost negative 80 basis points this morning.
This used to be the key indicator to forecast recession in 12 to 18 months' time. It is deeply inverted, the most inverted going back to 1981. We heard from Dean Kernet. We heard from Brian Weinstein. They see it going beyond negative 100 basis points. Does this give any indication as to the duration or the depth of the recession, or just simply signaling we're due for a downturn?
You heard Claudia Sahm there. I do wonder whether we start to see a little bit more division on this Federal Reserve at the next meeting. In the outlook, just how wide are the projections? How wide are the bands going into next year?
Or is it Lael Brainerd and everybody else?
I don't know. I think for a lot of people on the committee, I think you can say the same thing that Brainerd said, but also say the thing that Chairman Powell said. I think you could say both. You can say both. He did.
The key issue will be when we get down to 3.5%, right? Inflation. If let's say we get down to a level, does this Federal Reserve have the commitment to keep going? A lot of people say no, that they're going to actually loosen up, that they're going to perhaps respond more to the employment and to the economic picture. If they do that, what does that mean for longer-term inflation? What does that mean in terms of the resolve of this Federal Reserve to have the inflation mandate that it has traditionally?
Chairman Powell speaking on Wednesday, then the Federal Reserve decision coming on December 14th. Been through the dates a couple of times, worth going over again. The end of 2022 is just around the corner. On the 2nd, you get payrolls. That's this Friday. On the 13th, you get CPI. On the 14th, you get a Fed decision. And this week, I understand, the Senate, lawmakers returning to Washington, D.C. Henrietta Trace, Director of Economic Policy at Vader Partners, joins us right now. Henrietta, for you, what's top of mind as Congress gets back to business?
I think just like with y'all, inflation is top of mind still. It's certainly going to be a huge focus as we consider roughly $2 trillion worth of legislation in the next 2 weeks. You've got an $840 billion Defense Authorization Act. You've got a $1.5 trillion government funding bill. And then you've got what could be about $300 billion worth of tax credits. And if the inflation argument is that this is really supply chain driven and COVID driven, senators are going to be more apt to consider the R&D tax credit, consider extending the EBITDA instead of the EBIT shift that will save corporations roughly $86 billion between just one of those, and then 150 or so between the two of them, and then tack on another batch of child tax credit expansion. And those are the main drivers of the Senate for the next 2 weeks, obviously heavily hinged on inflation and that argument for a recession as well.
Henrietta, this doesn't compute. On one hand, they're worried about inflation. On the other, they're on the brink of passing potentially a $300 billion stimulative bill that helps corporations and helps households across the country. How do these two things go together?
It's an interesting dynamic where the problem here is that the tax credits expired at the end of last year. So if you speak with investors, if you speak with a lot of lawmakers, and certainly if you speak with corporations, it's not technically stimulus on the business side. It's just an extension of the status quo. I wouldn't anticipate that the markets receive a $300 billion tax bill as a inflation or government funding driven package. Instead, it's mostly an extension of things that we've had for the last 7 years as part of the 2017 tax bill that they're just expanding instead of driving us into a situation where corporations will have to pay more taxes due to just the expiration of those credits. On the child tax credit side, I think that's the inflationary piece because that's seen as more of a domestic stimulus for individuals, which is obviously a much larger basket. And you'll hear that argument from Republicans that they don't think it should be extended right now. You'll get the same on the COVID side.
In the meantime, though, and you say the COVID side at the same time that the U.S. is trying to deal with what the potential fallout could be from unrest in China, I'm curious whether we can expect some sort of response, whether there is any response or preparation for either way, supply chains to remain constrained for longer or sudden increase in demand for some of the same goods and materials that the U.S. is looking for as well.
Absolutely. I think a really good leading indicator of how Congress is going to respond to that is going to come later on this week, as early as Thursday, when they start debating the National Defense Authorization Act. There are several amendments that are already pending to that bill that pertain to China, that are about national security threats, are about, for example, TikTok and whether or not it can be on federal government employee computers and devices. I think you're going to see a precursor to that entire argument before they get into it really in earnest in the weeks ahead, starting on Thursday when they do the NDAA. So I'd watch for that.
China front and centre for all of us this morning, that's for sure. Henrietta, thank you for being with us. Henrietta Trace there of Vader Partners, all trying to work out the consequences of the protests, the demonstrations, Lisa, over the weekend.
This, to me, is the most important news over the weekend and potentially even of this year, heading into next year. COVID-0 and how long can it continue? Because that has completely suppressed growth. And when you start looking at expectations over at Deutsche Bank for 2% growth globally next year, which is basically in line with recessionary global forecasts in the past, how much does this hinge on China remaining shut? How much does this hinge on them continuing with their COVID-0?
I thought what Goldman had to say about an exit from COVID-0 was interesting. They said this: the central government may soon need to choose between more lockdowns and more COVID outbreaks. The current situation imposes further downside risk to our below consensus Q4 GDP forecast. Our 30% subjective probability of reopening before QT next year includes some chance of a forced and disorderly exit. That last piece is not something I've thought about much until after the weekend and the events we all saw play out there. A forced and disorderly exit of COVID-0. What does that look like?
I was thinking the same question. I can't pretend to be a China expert. I can say that as I was reading through different pieces of what that could potentially mean, they were talking about more protests, they were talking about more outbreaks, and if you can't control the outbreaks and people are just bursting out, then all of a sudden you have to sort of allow things to sort of unwind themselves. But if you get lockdowns, then more protests, then more outbreaks, this is disorderly, this is messy, but longer term it might get them out faster.
Vaccine efficacy is one problem
Yes.
in China relative to the vaccines that the rest of the world has been using, particularly the mRNA vaccines. So vaccine efficacy is one point, and the second point is coverage. It's amazing to me, that in the West we had this big conversation about vaccine mandates, and in some places we saw it in certain shapes and certain forms, and we've not seen that in China. An autocratic, authoritarian country hasn't gone forward with the same decisions that were made in the West over the last couple of years.
Take this even further. If the majority of an elderly population, the most vulnerable population, is not vaccinated, and if doctors were recommending against that vaccination initially in the cycle, why hasn't this administration of China come in and said, guys, you have to go get the inoculation because we have to have something of protective measure ahead of opening up?
That brings up the potential for what Goldman's talking about.
Exactly.
A forced and disorderly exit from COVID-0. I stress potential, and you can assign your own probability to the potential of that happening. Coming up, Lara Rain, the chief US economist at FS Investments. Looking forward to that. Futures down about 0.7 on the S&P. Yields unchanged on a US 10-year. From New York, this is Bloomberg. Two hours away from the opening bell, equities down on the S&P 500, negative across the board here on the S&P and on the Nasdaq too. We're down about 0.75%. Elisa's going to pick up on Apple in just a moment. I'm going to run through the bond market for you. 2s, 10s and 30s. The spread between 2s and 10s pushing negative 80. Pushing negative 80. Unreal. 10-year yields this morning, basically unchanged at 367. A 2-year up almost a basis point to 446.29. In the FX market, euro dollar, some outperformance on the euro, the yen in G10, the dollar weaker, euro dollar 104.66, positive there by 0.7%. Lagarde coming later. Klaus Knott a little bit earlier. We've talked about his comments a few times from the ECB. It is not the time to talk about over-tightening. Any talk about over-tightening now is a joke. I wonder how much of a joke it is to you at home listening to that kind of commentary coming from an ECB official.
It's a bit flippant. I don't think that Christine Lagarde is going to take the same kind of approach, and it really does sort of highlight how some people see this as so obvious and other people perhaps see this a little bit more questionable. What do you make of that?
I think it's kind of bizarre. I don't think it's a joke to be talking about that. I think that's a debate we should have for an economy going into recession as to whether you should continue hiking interest rates. I understand the concern around inflation. It's justified. We should have that conversation too. But to dismiss it outright as if anyone who's talking about it is having a little bit of a laugh. It's a joke. I'm not on board with that, no.
Especially because it lacks humility when we've gotten it wrong again and again. It has been so hard to say.
Particularly the history of the ECB's got it wrong again and again and again.
If people have gotten wrong again and again and we're in an extraordinary time, it's hard to be overly dismissive about any potential outcome.
December 15th, the next decision from the ECB.
Oh, well, it'll be interesting whether they also think it's a joke to think of over-tightening. I'm looking at a number of names, but Apple really is front and foremost, down almost 2% in pre-market trading as we see those protests disrupting some of the production at Foxconn. 1 in 6 iPhones, 1 in 5 of the new iPhones, iPhone 15, I believe, iPhone 14. Where are we at? iPhone 23.
You lost count.
Yeah, they're being produced in that factory run by Foxconn. It's also a demand story. Apple has been immune from some of the deepest pain in the tech sector this year. They're only down about 16% year to date. Does that start to change on the heels of what we're seeing over in China? That, to me, is a big question mark.
I couldn't agree more, and I think it's really complicated. It's incredibly complex. You heard Michael Purvis of Toolback and a little bit early this morning, about 20 minutes ago, talking about the risks associated with some of these companies moving supply chains. If you move your supply chain, if you shift your hub of production out of China and you're a company like Apple, what's the blowback look like on the demand side? Do you get that rise in nationalism against the iPhone, against Apple products because they've shifted their production base away from China? That's the risk that they'd be running, not just the increased cost of moving the supply chain and the production hub to I don't know where. There is also a risk of the demand blowback too.
This is the reason why a lot of people think that Apple hasn't moved as quickly. Another couple names that I'm watching Amazon shares up now after being down. Not necessarily that interesting given the whipsaw action that we've seen. But Shopify is interesting to me, and it's up more than 6%. It's that the platform for smaller businesses. And a lot of analysts are expecting there to be better than expected traction, a better than expected shopping season. What's more interesting is those shares are down more than 73% year to date. So it's sort of like, have we baked in? Are we starting to see sort of bottom picking at this point with people going in and trying to find some of the sort of baby that's been thrown out with the bathwater?
You're telling us all about Cyber Monday a little bit earlier.
It's so exciting.
About that again?
Thoughts?
Did you buy anything?
I bought something on Black Friday.
What did you get on Black Friday?
I got, do you really want to know?
You look so ashamed of this.
I bought chargers for the phones. I bought hats for the kids.
What was the discount like?
It was like 30%.
Okay, nice.
What did you buy?
I did that with some Nike sneakers, running shoes.
All right.
30% off.
This is great.
You know, the ones that make you run faster in marathons that I'm not going to run.
Seriously?
I was walking around the apartment with them on Sunday.
Yeah, springing along.
And I could just feel myself just walking quicker. You know, it really made a difference to me straight away.
Wear them outside?
They're not going outside. They're just going to the gym. They're not,
you're the only person with indoor shoes. Oh, my goodness.
What do you mean? You don't have shoes just for the gym?
Just for indoor shoes?
Just for the gym.
No. I run outside.
Yeah, but if you were, let's say they were just for the gym, you'd wear them outside too.
No, I take my shoes off when I come in. I'm one of those people. Anyway,
do you make other people take their shoes off?
No, I don't make other people take their shoes off.
That's good to know, because I don't like those people.
You don't like those?
I've got a lot to say about those people.
Otherwise, we might have an issue.
I've got a good friend who turned up to a party over the last couple of weeks, walked in, got to the door, and he got the shoes off memo from the people at the party. And do you know what he did?
What?
No, turned back around and left the party.
Well, but
I would do the same thing.
Do you take your shoes off when you enter your apartment?
Sure, but I don't force other people to. And I wouldn't either. I've got a problem with those people.
But if you actually cared about it, and you had a close friend.
Well, they're not coming in the bedroom, are they? They're going in the living room.
I don't know. I think it's a sign of respect. I usually take my shoes off.
No, I would for them. I would offer.
Exactly.
But I just wouldn't insist.
I think it's strange.
I think it's strange to insist.
I also think it's strange if somebody doesn't take their shoes off if it's clear that the shoes are on the front.
You know how much feedback we're going to get on this? I think it's very odd to make guests take their shoes off.
I think
to
it's
insist
odd,
on
though.
it.
I agree, but I think it's odd for a guest to not see all the shoes at the front door and automatically.
This is why we booked Laura Rank, the chief US economist at FS Investments, and she joins us now. Laura, great to catch up with you. It's a bizarre moment in this equity market because we seem to be pricing in a recovery to recession we haven't had yet. Laura, can you run me through the potential for this downturn in America?
Yeah, markets are so forward-looking. I think they've really gotten over their skis in terms of seeing this reduction in the pace of Fed rate hikes and automatically assuming that there's light at the end of the tunnel and easing is really on the near-term horizon. To me, I look at what's happening in the bond market and the very clear expectation or the probability of recession that the bond market's pricing in, and the fact that forward earnings estimates on the equity side are higher for next year. When we have a recession, we usually get a drop in earnings of 10 to 20%. That's what we've had historically. So we're really seeing this divergence in recession expectations in the financial markets.
Laura, you also think that it is potentially not right that inflation is going to fall so significantly next year. That is completely not consensus. Can you explain?
Yeah. So, I do think that inflation has seen its peak in June of this year. So I do expect inflation to fall. But I am an outlier in that I don't think we're going to see inflation neatly fitting back into this 2% box anytime soon. I think we're going to need to differentiate between inflation coming down. We see oil off so significantly this morning. Some of these base effects are going to drag headline inflation lower. But there's a real difference between that and a world where inflation is reliably and persistently low. That is the backdrop against which we've had the Fed, keep interest rates at the zero lower bound, cut interest rates aggressively over 500 basis points if the economy slows. I think we're in a world now where we can't just assume that we're going to mean revert back to the world, what we've had for 20 years before the pandemic. Look at what's happening in China right now. We need to really resist the urge that our quantitative models are telling us to mean revert. That, to me, is the biggest concern going into 2023.
People would disagree, Laura. They would say, well, we still have an older population. We still have a lot of debt. We still have all of the ingredients of low inflation, and that in 5 years' time, this Federal Reserve will be trying to get inflation up, not get it down and keep it at 2%. Why do you push back against that?
I think that what we're seeing right now, look at the 10-year Treasury. We have, if I had told you that we would have inflation of 7% in a 10-year Treasury that was still only 3 3/4, that is a world where demographic pressure is keeping the 10-year Treasury lower. We have quantitative tightening. We have the Fed selling Treasuries, or at least not buying them. And we have really, really high inflation. And the 10-year is still well below where inflation is. So I think it is a world where we're seeing demographic pressure applied to the long end. I just think that it's still a world where we're seeing, look at food prices. I think the expectation that supply chain disruptions are going to magically evaporate is being disproven this morning. This is still, we're seeing the echo chamber of COVID disruption. And I think really the genie's out of the bottle when it comes to inflation. Durable goods price deflation is a necessary portion of seeing U.S. inflation at 2%. And we're just not going to go back to that world in 2023.
Andrew Hollenhorst of Citi published just moments ago. He said the jobs numbers may serve to emphasise his hawkish focus on a tight labour market. He's talking about Chairman Powell. Laura, do you think that's important too?
I think this is critical. Wage growth of 4% is inherently inconsistent with inflation of 2%. We have had a lot of different recessions where we see very little change in output, but a massive decline in employment. This time around, you could get the other story. You could get companies really actually holding on to labor. That's part of the demographic story. And I think it's a reason why wage inflation is going to be much stickier on the decline. We've seen companies now have to continue to compete for workers. And I think that also is going to be a story for 2023. The wage numbers may become more important than CPI numbers, especially in the beginning of next year.
Interesting. Up like a rocket, down like a feather. I think it was Patrick Harker of the Philadelphia Fed a number of weeks ago. Laura, thank you. Laura Raimnet of FS Investments. Those of you interested in the comments from Citi's Andrew Hollenhorst moments ago, our base case would have Powell guiding a well-expected slowdown to a 50 basis point hike. But the team goes on to say, remaining hawkish, Lisa, by downplaying 1 month of softer inflation data, the jobs numbers may serve to emphasise his hawkish focus on a tight labour market.
All the rhetoric out of Fed officials has been the same, basically saying, yeah, step down makes sense, but that doesn't mean that we're going to have a lower terminal point. The market hasn't read it that way. If you look at what Fed funds futures are pricing in, it's below 5% now for next year in terms of the peak. It's come down quite a bit. How do they jawbone that back up if they are doing the step down? What we just heard there, though, from Laura Rame was really interesting. To your question, the wage numbers may be more important than CPI. How much does that start gaining traction?
Payrolls on Friday. Would you like the feedback? It's quite normal to take your shoes off when you get to someone's home. This from By the Index on Twitter. We agree. It's just about whether you insist on other people doing the same thing.
But don't you think it's a little socially...
Shoes off, risk off, whatever that means. It depends on the shoes and the flooring. High heels on wooden floor is not so nice the next morning. So you have to assess people individually on whether they have to take
but
the
don't you
shoes
think
off. Or you could just have a sign on the front door.
No, but don't you think it just makes sense? I mean, wouldn't it just social etiquette that if you see them take their shoes off, you sort of like it's sort of a sign of that person.
I take mine off. Just if you turn up at mine, I just don't insist that you take.
Of course, it's sort of the question of messaging and etiquette.
It's that game you play.
But would you invite
at the
them
front
again
door.
if they didn't?
Oh, depends on their behaviour, Bramo.
Ooh.
Futures down 7/10. They get a survey. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A sense of uncertainty is sweeping through Chinese markets as protests against the government and its COVID-0 strategy complicates its path to economic reopening. Goldman Sachs economists say they see a chance of a disorderly COVID-0 exit. Demonstrations across various cities and universities in China were fueled by a deadly high-rise apartment fire in Urumqi. Now, some blame virus restrictions for hampering those rescue efforts. Ukraine's President Volodymyr Zelensky is warning people to brace for more Russian missile attacks. In his nightly video address, Zelensky called it part of Moscow's effort to use cold winter weather as a weapon. Repairs are opening after a barrage of Russian missiles struck Ukrainian power plants last week. Federal Reserve Chair Jerome Powell expected this week to set the stage for slowing interest rate hikes. At the same time, he'll remind Americans that the fight against inflation will run into 2023. Powell will make a speech on Wednesday, one of the last from policymakers before the Fed's meeting December 13th and 14th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If the frame is a shallow downturn or mild downturn, we would just say, open yourself up to the possibility more and more that no downturn is something that we have to fully price in and something that is not yet fully in the price.
The brilliant Luke Cower, UBS Asset Management Director of Investment Solutions, live from New York this Monday morning. Good morning. We are negative on the S&P 500, on the Nasdaq as well. We're down about 0.75% through much of this morning. The unrest in China triggering some of the concerns. Feels like sell risk and ask questions later. We'll ask some of those questions in just a moment. In the bond market, a 10-year 367.75, 2s10s. I mean, let's call it. It's basically negative 80 basis points on a yield curve this morning, Lisa. The 2-year versus the 10-year.
The most negative going back to 1981. At what point have we reached the end of this, right? And we were just hearing earlier this morning, potentially negative 125 basis points. What does that mean in terms of the depth of this recession?
Brian Weinstein at Morgan Stanley talking up that number. That's unreal, isn't it?
And talking about a 3.25% 10-year yield, that we could see another leg lower in yields from here.
Apple, one more thing to watch. The stock in the pre-market is down by about 1.76%. Our latest reporting here at Bloomberg suggesting the turmoil at Apple's key manufacturing hub in China is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. Dan Ives joins us now, senior equity analyst at Wedbush Securities. Dan, I want to start with the Apple story and understand it from your perspective. Do you see that as profit, revenue lost, or just deferred, pushed out to the next quarter?
Look, I mean, it's been a gut punch in the most important quarter, the most important period for Cook and Cupertino going into holidays. I believe it is deferred, and ultimately demand right now is outstripping supply by about 3-1. But I think really, look, the clock struck midnight. Finally, Apple is seeing, what's really the hurt in terms of production in China. We think it could be 6 to 8 million units.
So what does this mean in terms of Apple's share price, in terms of the earnings that they're going to see, even if it's deferred? What does that mean for the upcoming quarter?
Well, I think in the near term, Street's factoring in that you're clearly going to see misses on iPhone production as well as what we're going to see on deliveries. I think, Lisa, the issue is even going to Black Friday, I mean, we're seeing about 25 potentially 30% shortages in Apple stores. If that continues to increase, depending on what happens on production, then this could be some darker days ahead in terms of the coming weeks going into holidays. But I think right now, Street's starting to factor that in. But let's just be clear. It's the Grinch that stole Christmas, really for Apple. And it's been a frustrating time for Cook and Cupertino.
This isn't a surprise, though, Dan. I mean, this is ultimately Apple's China problem, that their dependence on China, both from a demand side as well as a supply side, really ties their hands to policy that's highly unpredictable. How much is there a push internally to move away from production in China to increase, perhaps, demand and production elsewhere?
Yeah, and in terms of what we've seen even over the last year and a half, Apple's been able to navigate basically better than any other company, within China. The problem is that now at the most important time between the protests, zero COVID, and what we're seeing in Foxconn, it's really been a train wreck. I think for Apple now, they could talk about diversifying, but realistically, probably best case, they can move 5-7% production out of China by 2024. So I think their really hands are tied here, and that's sort of the frustrating situation because they are ultimately at the mercy of the zero COVID policy in China.
Well, Dan, let's build on that a little bit more. Want to ask the question whether it's profit or revenue lost or just delayed, deferred to another quarter. I think overwhelmingly the response from bulls like you is that it's deferred, just delayed until the next quarter. But Dan, underlying that assumption is that these difficulties in production go away over the next 3 months. Dan, I've spent most of this morning asking the question whether the working assumption is we get rid of COVID zero or whether we're stuck with it. And I can't get a definitive answer on that from anyone. And unsurprisingly, that's the case. So Dan, where does your confidence come from that the issues that these companies are experiencing this quarter are temporary in nature and won't just spill over into most of next year?
Look, it's a great question. I mean, look, our view is that ultimately, especially from a Foxconn perspective, they will be able to ramp production going into the next month or two, and then ultimately this will start to be more temporary. But to your point, it's an overhang. And it's really something that came to roost for Apple at the worst time possible. And really, ultimately right now, the Street's going to assume it's temporary, transitionary. But ultimately, if this continues in 2023, it would really sort of start to change the near-term thesis.
Well, that's the question you and I have explored a few times, Dan. How will I know if I'm wrong? You seem to have put a date on it there. If it spills into 2023, is that fair? Is that your line? If this continues for another month or so, I might have to change my mind about where I see this thesis going.
Yeah, if this continues for 4 to 6 weeks, look, then it starts to impact 2023. Then even iPhone 15. In terms of production, I think that's where it sort of cascades further. Right now, it's contained. You see that even reflected in the stock. But no doubt, I mean, this is starting to turn into a nightmare on Elm Street for Apple in terms of what we're seeing coming out of China.
It's contained, and yet we have heard about Apple potentially giving discounts to certain businesses on the margins, doing things that they have not done before because demand has so outstripped supply. And there's always been a willingness to spend $1,000 on a phone and people lining up around the block. Dan, is there a bigger problem for Apple that they're seeing both this issue on the supply side at the same time that demand is taking a hit in a way that perhaps they're starting to acknowledge on the edges?
Yeah, I mean, I think on the edges, you saw that in iPhone 14 Plus, which is really, I'll say, a strikeout in terms of as an overall, deliveries. But if I look at iPhone Pro, in terms of 14 Pro, it's 3-to-1 demand over supply. That continues to be robust. That's the frustrating thing for Apple. Even despite economic storm clouds, demand strong. They can't produce it. And I think that's right now what they're trying to figure out. And I think this is a key, I'll call it 7 to 10 days ahead, especially what we see coming out of Foxconn.
Dan, serious question. If you were hosting a holiday party, would you insist the people come over, take their shoes off? That's all we want to know this morning. Never.
I believe once you do that, it changes the whole dynamic. Once you ask someone to take their shoes off.
Are you sending a message to someone, Dan?
Look, I mean, Saturday night, a good friend asked to take our shoes off. It was awkward for about 15 seconds, and then it continued. I think it changes the dynamic.
Dan Ives of Wedbush. Are they still mates after this? I love that.
I don't know. I mean, are they watching? Maybe they'll watch.
How open and honest he is. You ruined the night.
Yeah.
It's a good friend.
It's a good friend. You ruined the night. You ruined the dynamic.
I love this message I got on the Bloomberg moments ago. High heels on a ceiling of the neighbour below. You in a high-rise is unpleasant. As Paul Simon sings, one man's ceiling is another man's floor. People forget.
Okay, I'm speechless because I grew up in an apartment and I learned how to walk much more softly after a number of the neighbors came up and
you tiptoed.
slammed. You sort of tiptoe, yeah.
In heels?
I don't know. I take my shoes off when I come in the door, so I'm not wearing heels inside.
You think they're suggesting that I might be wearing heels at home?
I think that's
my indoor Nikes.
I think that exactly. It might be I'm not going to go there. I do think that there is an issue, though, with
Tom does.
Noise. Oh, God, please. That's a horrible image. But I do think that with the kids, it's very tricky with noise. I'm just going to go to that and try to not to go to that image whatsoever. It is obviously a hot button issue. Do you think it actually changes the dynamic?
I think it does, yeah.
Because it basically, okay, but then how much do you tolerate somebody else's quirks in your home and just think, okay, this is temporary, this is temporary.
Well, as you know me very well, I'm a highly tolerant person, and I'll be coming up, Matt Diesel.
I can't.
Of Maryland Bank, of American Private Bank. Right, but very tolerant. What are you talking about?
Tolerant about what? Yeah, but if somebody
want to kick back on a sofa, they can.
Okay, but if they do that too much, you just won't ever invite them back.
You don't want them to get too comfortable.
Exactly.
Make yourself at home,
don't help,
but not
too
quite.
much.
Sort of like 80% at home, maybe. From New York, this is Bloomberg.
This year, a lot of the fear was about peak hawkishness and very high rates volatility.
As the economy is resilient, people just have to keep pushing back the timing of whatever recession or actual Fed pivot you get.
And if the Fed does too much, they're going to undo that relief and overdo it.
I think there is a slowdown coming through, and I think the Fed is acknowledging that.
We don't think we're really going to get a recession in the United States till 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK back in a couple of days. Equity futures down 0.75%. The main event over the weekend, and the concern spills into Monday. Lockdowns in China and aggressive pushback across the country to them.
How much does this end up leaving China in a different situation than it was in before? Basically, China having to capitulate to the groundswell of social protest against COVID-0, saying, okay, we have a problem here. We have to choose between more lockdowns and outbreaks, and we're going to go with more outbreaks.
Amazing to see how outspoken the United States is this morning. Again, another official this morning. It's difficult to contain a virus through zero COVID. That official went on to say, Lisa, that the United States says everyone has the right to protest, including the Chinese people.
How much is, okay, but that to me is a bit of a drumbeat on the whole, look, this is not necessarily a democracy, right? How much is this trying to message in something that is the one consensus in Washington, right? On the other hand, the U.S. needs China to open up for some of the supply chains to get worked through to help the inflation picture. It's also an issue with respect to global growth and how much that can really help bring the rest of the world out of recession as people are expecting.
This is a major, major issue for next year. For all the outlooks that have been published, haven't yet been published for 2023, how on earth do you have any kind of outlook without some kind of working assumption about whether China sticks with COVID-0 or ultimately moves away from it?
How quickly can that change, too? I mean,
sure.
That's what we heard from Brian Weinstein, who basically said, you know, our base assumption was that it lasted, and yet we might have to reconsider after the events of this weekend.
They can't answer the question. We said it a few weeks ago. If you're going to do an outlook for 2023, you should probably do two. One that includes COVID-0 and one that doesn't. Because no one can actually answer what the Communist Party's going to go with or not.
How about three? How about also whether it's going to be cold weather or we're going to get a cold winter, and whether COVID remains, the COVID-0 policies remain in China? I mean, how many outlooks do you need for such an uncertain backdrop with so many macro drivers that could really swing the difference one way or another?
So we're trying to get some clarity on the labour market December 2nd, on the inflation backdrop December 13th with CPI, on the Fed and the outlook. We get the summary of economic projections on December 14th, and that's kind of the final run-in, final scheduled run-in for 2022.
Wednesday, to me, probably the most important data point that we did not mention were the JOLTS job openings. And we talked about that with Lara Rame, and she said that she's going to be looking for, in response to your question, she's going to be looking perhaps to a greater importance on wage data and on jobs data than even the CPI.
Andrew Hollenhorst of Citi, totally on board. He said this morning the jobs number may serve to emphasise a hawkish focus on a tight labour market. Is that going to be the shift from this chairman? And is that how this chairman stays somewhat hawkish, even as we start to see downside surprises on CPI and PPI as well?
We've seen anecdotal layoffs, particularly in tech companies, but tech companies only account for about 2% of the overall labor force in the U.S. we are seeing companies hang on to their workforce because they've already been burned by not being able to bring people back. If that's the contour of this economy, is that a good thing or a bad thing? A good thing because people keep their jobs, a bad thing because perhaps the Fed can keep rates higher and raise them higher than people had expected.
A great story in the Journal over the weekend about how much these tech companies have hired in about this much time through the pandemic over a couple of years. We discussed Amazon doubling the workforce, Meta as well, doing the same thing. If anything, those companies have overhired through the pandemic and beyond.
That's why this is an idiosyncratic kind of sector that you can't take as a reflection of the broader sectors, because they did overhire in terms of some of the analyst expectations and analyst assessments. And so they're basically just going back to where they were before, or not even. And so it's hard to view that in terms of this is really a huge weakening in the labor market.
Futures down 0.8% on the S&P, on the Nasdaq 2 this morning. We are negative. Euro dollar positive by about 0.8%. Euro dollar 104.75. Yields unchanged at 367.56, but the spread between 2s and 10s, negative 80 basis points. Matt Diesel joins us now of Maryland Bank of America Private Bank. Matt, can we start with that yield curve? 2s, 10s at negative, let's call it negative 80 basis points. What are the limits of that trade, Matt? How much further can we push that?
Yeah, that's right. Negative 80 basis points. We haven't seen that in 40 plus years. Right? Last time we were this negative on 2s, 10s, I think Flock of Seagulls was top of the charts with Iran. So this trade probably doesn't have that much more to go, but we'll stay away from exactly predicting how inverted it's going to get. Lisa was making some very good points up front there, Jonathan, just like the tube in London. We got to mind the gap here. The yield curve, the labor market, and risk assets are all saying very different things at the moment.
Which one do you believe, Matt?
So I'm trying to find a narrative that explains all of it as usual. And I think the best way to think about it is the yield curve is definitely telling you a recession is coming. It's not here yet, but the check is certainly in the mail. 2s, 10s, that inverted. Fed funds 10s now inverted with further hikes coming. That tells you a recession's probably a lock. But the labor market, Lisa, as you're pointing out, it's very strong. And even though there's anecdotal evidence of layoffs, you're not seeing a lot of jobless claims. The unemployment rate ticking up, which means that risk assets probably haven't bottomed yet. And then you look at credit markets, you'll see investment grade credit around 130, high yield around 450, way away from recessionary levels. So it tells you that the recession is probably delayed but not denied, and might be coming later. But the more difficult the macro picture gets, to your point earlier, Lisa, in some ways the easier the investment outlook becomes, in our opinion.
Because if it's a lock that there is going to be some sort of downturn, then you can go to the normal recessionary playbook where risk will do less well than perhaps safer assets. And we haven't been there. It's been turned on its head. Is that basically what you're saying? That the end of financial repression will leave us with yield, but we're still on the path there that's going to be rocky and sort of a motley, but we're getting closer.
Well, we are very thankful for, Chris Heisey, our chief investment officer, was asking us, what are we thankful for? And very sincerely, we are extremely thankful for the end of financial repression. The ability that savers, people saving for college or for retirement, or older people living on a fixed income, any American of any stripe at any part of their life cycle can now get savings above the inflation rate. We haven't seen that in 10 to 15 years. That is a great thing for people across the country. We're very thankful for that. In terms of the asset markets, because the future is always uncertain, obviously. Now it's particularly uncertain, as you mentioned, with the labor market, the disconnects with the yield curve, what's going on globally. Pull your horns in, right? We do think you should be close to fully invested. We are underweight cash at the moment. We are making sure to be overweight fixed income, but don't be too overweight growth or value. Don't be too overweight spread products versus treasury and Asian mortgage backs. All you have to do is be relatively close to your strategic targets across your assets, be close to fully invested, not too short duration, and a 60-40 portfolio over the medium to long term should do quite well from these valuation levels.
Matt, how do you convince people to be fully invested going into what you anticipate will be a recession?
Yes, it's very difficult. And one of the most difficult points is actually the fixed income market, where obviously the highest yields are about, the 1 year sector. 1 year T-bill is probably the highest point on the yield curve right now. So we see lots of clients, and I talk to lots of clients who are allocating money there. And they're saying, Matt, this is easy, right? I can get more yield and no interest rate risk by being on the short end of the curve. Why would I ever go out longer? And we try to explain, right, without being too nerdy, right? Like the conservation of mass, that mass is never created or destroyed. It's the same thing with risk. Risk is never created or destroyed. It just takes different forms. So for clients who have abandoned longer-term fixed income to move into cash, yes, they're eliminating interest rate risk, but they're way increasing reinvestment risk. And that 1 year rate, which looks wonderful right now, if you're investing for the long term, in a year, 2, 3 times, it might drop. And you're really creating a lot of reinvestment risk if you move all to the short end. So we're trying to convince clients that by abandoning longer-term fixed income, staying short, yes, they're reducing interest rate risk, but they're taking a lot of reinvestment risk. It makes a lot more sense in your fixed income portfolio to be neutral with an eye to going longer. When the curve gets this inverted, that's generally a sign you should be longer. That teaser rate, that attractive short-term rate, can try to trick you to do the wrong thing, in our opinion.
Matt Dezok, thank you, sir, for your opinion of Maryland Bank of America Private Bank on a yield curve. That's going to be a hard sell, a tough pitch for a lot of people, Bramo.
It's going to be a recession, but in a recession, you're going to want the yield, even if it's lower than what you're getting in the short end. And in a recession, the reason why I'm wrapping my head around this.
Trying to work out in real time or just doubting what you just heard?
I think I'm working out in real time what it means, because in a year time, the reinvestment, ostensibly, if you're in recession and stocks are pricing in recession, there could be other entry points, perhaps just not in fixed income, right? So I'm just thinking through this out loud, but I'm going to move on. I do think it is a hard sell, but you are seeing people do it. You are seeing people go into longer-term yields.
Everybody listening wants you to move on. We want more.
What to say, basically, I'm not.
You disagree?
I just think that in a year's time, ostensibly, we could be pricing in the end of recession in stocks. If there's a potentially 19% downside, as Deutsche Bank said in their review, from the S&P from here, then wouldn't that be a better entry point for some of that cash that was coming off? What do you think?
I think you made good arguments.
Oh, you punted. What do you think about shoes?
I can tell you a lot about shoes.
Evidently, but you're going to punt on this,
huh? Can tell you a lot about shoes too. Senior equity research analyst at Cowen has got a lot of things to say about retail, and Lisa's very excited for Cyber Monday.
Oh, yeah.
It's a big event, big
Thoughts?
shopping event, I'm told.
Yeah. Any other thoughts?
Well, that's your first question for Oliver.
What,
at the moment.
thoughts?
No, I don't spoil it. This is the tease, Lisa.
Thanks.
I want people to stick around from New York.
Now.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, in China, protests against COVID restrictions are spreading. Citizens took to the streets and university campuses and vented their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai, where some called on President Xi Jinping to step down. That's a level of defiance unheard of since Xi took power a decade ago. The price of oil has fallen to its lowest level in almost a year. The protests in China clouded the outlook for energy demand. West Texas Intermediate, it fell below $74 a barrel following 3 weeks of losses. The unrest helped the dollar as a haven, which made raw materials less attractive. Retailers in the U.S. saw modest growth over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic, it ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts lured shoppers seeking a break from inflation. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. And shares of Credit Suisse hit another record low today, and they're on track for their longest losing streak since 2011. The Swiss bank has fallen for 10 straight days, losing as much as 27%. Last week, Credit Suisse warned about massive outflows in the core wealth management business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
there is a slowdown coming through, and I think the Fed is acknowledging that, and that's part of the reason why it's talking about moderating the pace of hikes relatively soon.
Big week up coming up with the Federal Reserve Chairman Jay Powell speaking on Wednesday, and payrolls coming up on Friday. Then the Federal Reserve decision coming up on December 14th, just after CPI on December 13th. Equity futures right now down 0.8% on the S&P 500, going into the opening bell, looking to climb through November for another month of gains on the S&P to add to the gains we saw in October and take a chunk out of the losses we've seen through 22 so far. Bramo trying to get back up there.
This is exactly Mike Wilson's crystal ball. He said that we would get a rally, potentially to 4,100. And here we are.
And then get hammered in Q1.
Exactly.
Off the back of the earnings story for Q4.
That's the consensus. Even Deutsche Bank says that we're going to potentially rally more and then we're going to come off. This is the consensus. It's sort of a technical, yay, end of year. Let's buy a Christmas tree at Thanksgiving.
If Binky Charter gets his 47.50.
Yes, what then?
I owe him a monster apology.
You know what?
For laughing at his
All
call.
you have to do is just wear a fat tie that day.
A fat tie? Is
Yeah,
that
yeah.
what why a fat tie? Is that
Because
what
it would just be like the real sort of acknowledgement.
What do you define as fat?
Not that.
Not that.
Yeah, we'll
wrong with
discuss
this?
it. I think it's great, but it's your style. It would be sort of the biggest capitulation would be to wear, a big tie or else a
That
white
says,
suit.
I'm sorry, Binky.
I'm sorry,
What does
Binky, for
Binky
every
wear if
doubting.
we don't get 47.50?
He has to wear a skinny tie for the rest of the
Okay,
year.
well, that's probably an improvement, isn't it, if everyone goes slim? No?
Binky, we're sorry.
Oliver Chen joins us now, Senior Equity Research Analyst at Cowen. Oliver's got things to say on that. He actually does. Oliver, I want to understand this. Lisa's been joking about Black Friday, Cyber Monday. Help me understand whether Black Friday started on Friday or back in May when Target reported earnings.
Well, Black Friday has been going longer, particularly with Amazon and Amazon Prime. However, what's really happening, John, is shoppers are coming back to pre-pandemic habits, and they are shopping later. So we will see later shopping, people really going to stores close to need. That's happening as well. Keep that in mind. Overall, we are enthusiastic about what we saw in stores on Friday. We're positive on Cyber Monday. We're looking for holiday sales overall plus 5 to 7%. And traffic was quite attractive. Black Friday has really changed. Not as many doorbusters, a little more relaxed and more convenient, but it's still very important, John.
Yeah, well, nobody wants to wake up at 4 a.m. to go to the stores. I mean, that's probably part of the reason why everyone's kind of giving a sigh of relief that doorbusters are kind of fading into the past. You talked about foot traffic being good. Yes. However, the discounts also were very good. How much are you going to see this bleed into massive margin compression because people are looking for those discounts?
Yeah, Lisa, that's 100% correct. Gross margins, as we model them, down anywhere from 50 to 100 basis points or more in fourth quarter. So in the guidance that a lot of retailers have out there, there's merchandise margin pressure, meaning there's a lot of promotions in the marketplace, 20 to 40% or more. And the big problem is inventory levels are too high, 10 points or more too high. So there's billions of excess inventory as well. And retailers are working through that. That should be very good for the consumer, 30% plus. But as John and I were talking, not all inventory is on sale. There's pockets of great strength, and that really feeds into the consumer being bifurcated. Luxury, premium, that's been a stronger market generally. But inflation is a huge deal for the middle and low income consumer.
Oliver, talk to me about luxury and how it's holding up, because one transformation we've seen over the last, I would say, 5 years or so is how much access to very, very high-end brands has increased off the back of buy now, pay later. Can you tell us how that trend may have reversed over the last 12 months or so, given what's happened with access to credit and what might be happening with these luxury brands down the road?
Yeah, we're really watching that because the savings rate has declined to 3.1 versus a 7 to 8% average, and the dollars on the sidelines, there's still over $500 billion on the sidelines, but it's declining. So that's something we're watching. What we see in luxury is the access luxury points, such as the belts and footwear. Those have been more over inventoried. But as we think about super premium brands, Chanel, Hermes, Brunello Cucinelli, those trends have been very strong. The U.S. has been very strong. Also, U.S. tourists going to Europe. European numbers have been strong, too, in luxury goods. Overall, it's been a resilient market that's been able to achieve pricing. And don't forget, going out and travel, fashion, dresses, all these events that we're seeing, it's important to look good, feel good, have the right accessory, footwear, and suiting. You know, we're talking about ties. going back to work is a new wardrobe refresh. It's not about lounge anymore. It's really about this dress up and suiting it over swimwear in terms of what we're thinking, what's happening now.
Oliver, can we just finish there on the suit? Where should we go and get a suit from now? Because whenever I look for suits, let's take Hugo Boss, great example. If you go down to Hugo Boss on Broadway, the suits aren't even in the front window anymore. They push them to the back. They've hardly got any in stock. Who's making suits now? Who's sticking with it?
Well, this is Brooks Brothers. So back to the future, back to the 90s, and that's a heritage brand. I like what they're doing. And then Nordstrom has a very competitive men's offering as well. And you call out Hugo Boss. They have a rich history of executing in men's too. But we'll see. It's an interesting question, John, because men's clothing, men's suiting, the versatility, looking for comfort. It's really about mix and match. It's Rhone pants and athleisure plus a tailored top. That's happening too. But there's also a return to formality. So lots of different trends happening simultaneously. I have been personally shopping Brooks a lot lately.
I know a ton of men waiting for Lulu to make a suit.
I know.
Just
actually,
the Lululemon suit.
Well, there's Lulu suits. I have a Lulu blazer, a Rhone blazer.
See?
And comfort matters too. So we're really seeing technology hit clothing and fabric. That's a trend as well.
It's the Midtown uniform, isn't it? The Patagonia vest and the Lululemon pants.
Stealth lounge wrapped in sort of dressing up.
Is that
that's the Lululemon.
trend?
That's, well, I mean, because people want to be comfortable, but they want to look like they're not, right? They want to look like they're dressing up and they're going to the office, but they kind of still like the lounge. I'm just trying to
be comfortable, but look like they're not.
Well, look like they're dressing up. I'm thinking about this because I was speaking with one of the heads of a pretty major clothing company who was talking about buying and that shift where they were moving from loungewear to office wear. And there are no statistics, there are no charts. The trends all just shifted. Suddenly people wanted to go back to the office and go out, but how do you prove it, right? And so then when do we prove that people are getting sick of dressing up? You know, I mean, how do you prove these trends?
Oliver Chen's not sick of it.
No,
Oliver Chen,
no,
a coward.
he's-
Oliver, thank you. It's always good to catch up with you, sir, around shopping season, going into Christmas.
Do you have some
the
tips
holidays.
now on
no,
suits?
just suits. I'm struggling.
Really?
Yeah.
I thought you have one brand you always go to.
No, I have a few brands, but I'm struggling. The brands I like don't have things in stock. It's been very difficult to get the things that I like. It's been difficult.
But that is the key, that luxury brands, since yours are luxury brands tend to have smaller inventories and bigger demand because people are still clamoring for those products. That's the truth.
What do you think of buy now, pay later and all of that stuff?
I think that we're starting to see some credit deterioration on the consumer
No, I think
side.
all of a sudden stuff like Gucci became very accessible to a lot of people. It became a monthly payment.
Which-
monthly payment instead of a lump sum.
which also bid up prices. So do you start to see a lot of the demand pulled out of the
Well,
market?
at this point, it's going to be fascinating to see how these luxury brands deal with it.
I think the people who have money, though, if you look at the savings rate, it's still pretty massive.
No, they have money. I'm just saying that not everyone who had money shopped at those stores over the last 5 years.
It'll be more selective, perhaps.
It's going to be interesting to see what happens. From New York, good morning. This is Bloomberg. $60 minutes away from the opening bell. Equity futures down 0.75%. Big week ahead. Payrolls on Friday. The Federal Reserve Chair Jay Powell speaking on Wednesday. Then into December, you've got CPI on December 13th and the Federal Reserve decision on December 14th. So they're the markers on the calendar going into year end. Right now, equities are lower by 0.75%. Yields unchanged on a 10-year, 367.19 in the FX market. Euro showing a little bit of strength. Euro dollar 104.49. Trying to work out what's going on with crude. 74 handle on WTI. It was lower than that a little bit earlier. We're down by 2.8%. The move we've seen on WTI, though, from the low 90s to the low 70s, Lisa, in just a couple of weeks.
Especially because what we saw over the weekend, does that give people conviction that China can stay with COVID zero? I mean,
no idea.
Is that basically what lower oil prices implies, or just that more volatility could potentially suppress growth in the near term?
That screen this morning just screams sell risk and ask questions later.
Exactly.
The events of the weekend, I've got no idea what the consequences will be.
Although sell risk, then what explains the dollar? Why is the dollar so much weaker? Because normally when it's a risk-off kind of feel, the dollar strengthens. The most notable trade to me is that the dollar has steadily weakened to the weakest versus its peers going back to August, if you look at DXY.
Since it peaked back in late September, the turnaround we've seen on things like sterling, cable from 103.50 through 120, Euro dollar from, I think, 95.95 to 104 right now.
Have you seen the yen? The yen
Massive
is
moves.
absolutely massively rallied versus the dollar, which is completely counterintuitive because they haven't changed their yield curve control policies.
138. They're just hoping and praying something around them changes.
And they're
they
getting
don't have to change.
But again, this makes me wonder whether this is all just, I don't know, positioning squeeze and kind of rearranging heading into year end rather than something that we can really create a narrative
If it's
around.
something you can't explain as positioning, right?
Correct.
That's
Absolutely.
always the way.
I try.
Ray Farris joins us now, Chief Economist at Credit Suisse. I'm pleased to say joins us in the studio here in New York. Ray, fantastic to catch up with you, sir.
Great to have me. Thanks.
Let's start with the chairman on Wednesday. What are you looking for from Chairman Powell this Wednesday?
He's going to find a way to slow to 50 basis points and yet still be hawkish.
How does he do that?
I think the way he does it is similar in nature to how he did it at the last meeting. He stresses that they've still got a lot of work to do. He quite possibly might suggest that, well, they don't stop at 5. They may have to go to 5.25, and that they're going to stay there for longer. They'll continue to point to the labor market being strong to justify all that. But I think the messaging out of the Fed is that they're not wild about this rally in treasuries, rally in markets, the easing in financial conditions that's come with that. And I think they still just absolutely hate markets pricing them to cut into the second half of next year.
They've already pushed back against this. This is the most amazing part. They've already said, stop it. We don't want you guys to rally because we're not going to cut. They said this again and again, and the market still has moved against them. What else can Jay Powell say other than, we're not going to stop at 3.5% inflation. We're going to keep going. How do they signal we are going to have some sort of call? We're going to have basically a cap on how far you guys can go.
I think he'll, again, do what he did in September. He's going to point to a higher terminal rate as a real possibility for the Fed. Keep open the idea that 5.25 could be there. And there's only so much, negative term premium that I think markets can take. So we're not going to disinvert the curve. That's just not going to happen. I don't think it happens unless something really fantastic happens in Europe that creates an outlook for Europe to come out of recession. But the more you drag the front end higher, the more that the back end of the curve is going to have to be dragged. It's going to have to creep up as well.
A lot of this has to do with the actual economy and the actual data. And people say keep watching the data because the Fed doesn't know any better than anybody else. And we heard from Lara Rame earlier this morning of FS Investments that it all is about the labor market and that ultimately the wage data might be more important than the CPI, given that there is this stickiness, there is this strength in the labor market that puts a lot of pressure on the Fed.
The labor market justifies what the Fed's doing. The CPI is the objective. If the Fed can get inflation down to close to its targets with a labor market that remains pretty healthy, really remember that in 2019, the labor market was pretty strong and inflation was where the Fed wanted it. If anything, the inflation was a little bit low. So one of the things that we've been pointing out is, the idea that inflation, or I should say that unemployment has to go back to 5.5%. Or that average hourly earnings growth has to fall to 3% to be consistent with the Fed's objectives. History just doesn't support that. So if the Fed can achieve disinflation with a labor market that's only modestly weaker than it is now, it'll take it. Inflation is what the Fed's going to focus on.
How much has changed between the pre-pandemic labor market and the labor market we have today? How much has changed when it comes to things like where the neutral rate may or may not be this time versus compared to them? How much do you think has changed?
I think the key thing that's changed is we've taken, in a labor market that's already lost a lot of potential workers because of immigration changes that have reduced immigration since 2016, we've taken a lot of workers out of the labor force. So labor force participation rate has fallen, particularly among older workers, 55 and above. And although it's creeping back up, it's going to take a lot of time for it to really recover. And so from the Fed's perspective, what that means is that for all intents and purposes, you've had a permanent shift lower in labor supply. And that's part of its problem. But look at the inflation data. Goods prices are beginning to do what they're supposed to do, with a strong dollar, falling import prices, softening consumer demand. Although discounts in this Thanksgiving Day and Black Friday were not epic, there were definitely discounts. One of the big fears we had that retailers would say, we want to protect margins, that didn't really materialize.
Sure.
In the housing market, housing is one of the strongest components of contribution to CPI right now. It's also one of the things that's most forecastable. And rentals are now beginning to come off. You look at the high-frequency data, and in September and October, rentals actually fell. House prices are coming down. So it really comes down now to just non-housing services. And that's still running a bit hot. The labor market looks like it's beginning to soften. We think services growth, non-housing services will continue to grow, but will again soften into 2023, and that'll start to come down. It's going to take until the end of next year. It's not going to be, first quarter or second quarter, we don't think. But the Fed has a reasonable chance still of getting a disinflation that doesn't require 5.5% unemployment.
So the Fed's not going to keep on hiking until they see 2%. They're going to keep on hiking until they're convinced they're on the trajectory to go back towards 2%. What does that look like, do you think? How do you know? What convinces you?
That's the million-dollar question that the Fed has right now. So the slowing is about the fact that the Fed knows it is now restrictive. It knows that because it can see it in housing. It can see it in other areas, some major company layoffs. But it doesn't know how restrictive it has to be because it can't trust its models. The message out of senior Fed officials is the models didn't forecast inflation on the upside. Why should we trust them on the downside? So we have to look at the hard data. We have to be backward looking. If you're going to be backward looking, you run a much higher risk of overdoing it. And how do you manage that? Well, you gradually slow down the pace of hikes while still remaining hawkish and saying, we're going to keep going until we've got mission accomplished. So we think they do 50 in December. They probably do another 2 25s in the first quarter of next year. We don't rule out the possibility they go to 5.25.
How different is your economic outlook depending on whether China exits COVID-0 or not?
I think the main thing in my mind, the risk, and that's a key question, because the risk that emerges from China exiting COVID-0, and particularly a sooner than expected risk, is all about energy. I think one of the biggest vulnerabilities from an inflation perspective for 2023 is energy. U.S. inventories have gone from 1.2 trillion barrels of oil down to 800 million, roughly speaking, and are continuing to fall. We're about to get a regime in Europe that is going to take some Russian oil off the market. And remember that Russia's actually been supplying the market pretty much at the rates it was supplying the market before the invasion. And if the oil prices have fallen, but they're still above 2019, pre-pandemic levels. If China comes back in and adds back demand of, 1 million to 1.5 million barrels per day, we could get oil prices bouncing again. And that would be particularly unhelpful.
That's the problem, isn't it? Is it bullish or is it bearish if China reopens?
You've been asking that question. We've been asking that question. Nobody has a straight answer because on certain aspects it'll be bullish with respect to global growth, and then it's really bearish when it comes to economies that are going to struggle in the face of higher energy prices.
Go on, Ray. It doesn't really do much for the U.S. economy. It will contribute a little bit, probably, to some corporate earnings. It really focuses much more from an investment perspective on China itself and Asian assets. Asia has a much bigger gearing to Chinese reopening and a greater degree of activity in China, especially Chinese travel. That's going to benefit Thailand. It's going to benefit the Philippines. It's going to benefit Southeast Asia much more than the United States.
And some of the luxury names in Europe, that's for sure.
Balenciaga
in
or
a major way.
Hermes, yeah, exactly.
The rally we've seen in European equities off the lows of late September have been phenomenal. Ray, this was awesome. Thanks for being with us, sir, as always. Ray
Thanks for having me.
Of Credit Suisse. Coming up at the Open, we'll be catching up with Matt Miskin of John Hancock Investment Management, Greg Staples of DWS Group, and Victoria Fernandez of Crossmark Global Investments. Looking forward to that. Bramo, as we kind of count down towards the end of the year now, just a few events to go, a handful of events before the end of 22.
Yeah, I mean, it kind of feels like we just have 2 more weeks and then we're done. And it feels like people are kind of jittery heading into year end because there are a lot of big events and there isn't a lot of conviction. Do you feel conviction?
The year ends on December 14th.
Yeah, I would say that that's right.
You skipped the ECB meeting?
Yeah, pretty much. I mean,
tell us how you really feel about the European Central Bank.
The ECB, what are they going to say? They're going to say we're going to keep tightening rates. I don't think that they're going to have Klaus Knott's kind of view. I think that that's a little bit too flippant for the ECB. I'm interested to hear what they have to say. What do you think they're going to say? Do you think it's an important meeting?
I think it's always an important meeting. They're going to hike into recession. It's kind of brutal.
It's brutal. Do you think that they're going to say that it is recession?
That would be interesting. See if the base case shifts.
Well, in the meeting minutes, the Fed was basically saying that.
They're going to wait until they actually just see one and say, yeah, now we're surprised. The base case has shifted. It's kind of ridiculous. When's Tom's back?
Tom's back Wednesday.
Wednesday. Good for him. All right. Futures down 7 cents. The opening bell, 50 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A sense of uncertainty sweeping through Chinese markets as protests against the government and its COVID-0 strategy complicates its path to economic reopening. Goldman Sachs economists say they see a chance of a disorderly COVID-0 exit. Demonstrations across various cities and universities in China were fueled by a deadly high-rise apartment fire in Urumqi. Now, some blame virus restrictions for hampering those rescue efforts. Ukraine's President Volodymyr Zelensky is warning people to brace for more Russian missile attacks. In his nightly video address, Zelensky called in part of Moscow's effort to use cold winter weather as a weapon. Repairs are ongoing after a barrage of Russian missiles struck Ukrainian power plants last week. In Houston, schools are closed today, and residents have been warned not to drink tap water without boiling it first. That's because power outages have shut water treatment plants. Office towers have told tenants the problem will not affect fire suppression and air conditioning systems. After cutting thousands of jobs, Twitter now hiring. That's according to slides from a company talk tweeted by owner Elon Musk. The first slide had the words, "We're recruiting," with no further details. The slides also said that new user signups are at an all-time high, averaging over 2 million a day the second week of November. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Even in the US, slowing economy across Europe, and it's, how do you go running out on all these cheap prices to buy things when you're worried about energy costs, worried about mortgage payments, and so on. So, the global economy is clearly slowing, and that's the backdrop.
Kit Duke, Societe Generale Chief FX Strategist, on Cyber Monday, when a lot of people are going out and buying things, but on discount. And we've been talking about that throughout the morning, underpinning a lot of the angst this morning. So we are seeing equities lower. We are seeing bonds higher, yields lower, the traditional risk-off kind of feel in markets other than the dollar, but we'll get into that later. How much is this really being fueled by what we're seeing over in China with ongoing and spiraling protests that are causing some to draw analogies to 1989? Joining us now is Tom McKenzie of Bloomberg, who spent about a decade in China. How different is the nature of these protests that you're experiencing now versus what we've seen over the past few decades?
Yeah, Lisa, during my time in China, I witnessed protests. They were normally almost always localized, specific issues, and almost always targeting local governments. Very rarely did you hear criticism of the central government. Very rarely did you hear criticism of the party secretary, the president, in this case, Xi Jinping. This time, it is different. And I can think of no other event other than 1989 that is comparable. And it's easy to reach for that as a heuristic, but I don't think it's hyperbolic in this instance, because you have multiple protests in multiple cities happening at the same time around a similar set of shared issues and concerns. And that we have not seen since 1989. And therefore, you are going to have the officials sitting in Beijing deeply concerned. And the response from them is, of course, what we're all watching next.
We're hearing reports of Chinese television cutting away from images at the Qatar World Cup of people enjoying without masks. There is a clampdown on information. How surprising is it that these images are getting out?
This is the dual world that the people of China are living in now. They have spent 3 years faced with these kind of restrictions. And the restrictions that we've seen in the last few months are the tightest they've been within that period. There's a huge fan base when it comes to soccer or football in China. So they're going to be watching it, and CCTV, the state network, has the rights to it. But you're absolutely right. They've been trying to make sure that they can't see the thousands of fans in those stadiums without masks, because, of course, that is our reality, and that is the reality of most people outside of China's borders. That is proving another friction point for people stuck at home as they watch these scenes. This is a Chinese leadership that has squandered its own success initially in the early 2020s, of course, when it clamped down on what happened with COVID, when it spread out of Wuhan. It clamped down very effectively. The death rate in China is very low. The infection rate is very low. It's nowhere near the death rate that we got here in the UK, in the US. But they've squandered that time to build out their healthcare system, to ensure those vaccination rates are higher for the elderly, and to put in place mRNA vaccines that they still do not have access to in China.
So which raises a question, Tom, and we've been asking this all morning. Why haven't they taken a stricter line with vaccinating older individuals? Why haven't they come up with vaccine distribution methodologies that could potentially create some sort of collective immunity?
So on the top line, it looks quite good. About 90% of China's population have been double vaccinated with either Sinovac or Sinopharm. There's questions, of course, about the efficacy of those vaccines, particularly compared to mRNA. But when you lift the lid on those numbers, you realise that actually above the age of 80, and of course the vulnerability is there with those age groups, the vaccination rate is closer to about 70% compared to, say, 90% in Japan or Germany. Certainly lower as well than the vaccination rates of that age group in the United States. Why haven't they got more vaccines in arms remains a question. They obviously have the manpower to be able to do that. It's an authoritarian state. They haven't done it. There's a deep reluctance amongst the elderly population about getting these vaccines, and breaking down that reluctance and that concern is something they've struggled to do. The other question is, why haven't they approved mRNA vaccines? I remember speaking to the head of the conglomerate Fosun in 2020 in China. He said, we are going to be getting the rights to the mRNA vaccine. That never happened. That appears to be a nationalistic decision by the leadership in Beijing. They wanted to be able to generate and develop their own mRNA vaccine. They've yet to do that.
It's folly to try to predict what Xi Jinping is going to do. People are trying to do just that because it makes such a big difference in terms of outlooks for next year, with some people, including Goldman Sachs, saying that this increases the chance of a messy exit to COVID-0. What does that look like? Do you think that this increases the chance of a forced and messy exit from this policy?
A messy exit may be the implementation of these restrictions at a slightly softer level. They put in place this 20-point plan that they published a couple of weeks ago. The challenge for local officials on the ground is trying to implement those, having spent the last 3 years fearing being punished for not curbing the rate of infections. So the two things colliding together, and if you're a local official in that jurisdiction with that 20-point plan, it's very hard to implement, given you just spent the last couple of years with that fear in terms of what the central authorities are looking at. So this could be a mixed approach of easing some of these restrictions, trying to ramp up the healthcare facilities to ensure that they can absorb the increase in infections and possibly, sadly, the death rate as well. That would be the messy outlook. The history of Xi Jinping is that he has stated that he has studied the Soviet Union's collapse, and he said it collapsed because they were not strong enough, they were not brave enough to confront the challenges within their domestic population. This is a man who studied the fallout of the Soviet Union. He does not want to see the same thing happen. That suggests he will be taking a hard line on these protests.
Okay, but what does that mean, right? Does that mean throwing everybody in jail? Does that mean that there's just going to be a complete clampdown in a new way? Or does it mean that COVID-0 gets even more intense? Is that kind of what people are expecting?
It may be a combination of all those things. You may see the security services starting to target now who they would consider the ringleaders in these protest movements across these various different cities. Certainly the clampdown in terms of censorship online, and you've seen a lot of videos shared online. That's been surprising in itself that they haven't been able to maintain and contain that yet. Those things, I'm pretty convinced, will be coming, sadly, for the protesters involved. And then, at a later stage, they may start to ease some of these COVID restrictions. They won't want to do it now. They won't want to apologise, because that will be a loss of face for the leadership. But in the months ahead, it would be unsurprising. It would be surprising to see that they don't walk back some of these restrictions and try and walk this fine balance, this fine line to the end of COVID-0. Whether that's before Q2, as Goldman Sachs says now, their 30% chance, or in the second half of 2023. The imperative is clearly there.
Tom McKenzie of Bloomberg, thank you so much. We really appreciate your insights. It's been a tremendous moment as we watch some of those images of people holding up blank sheets of paper to indicate the censoring that they are experiencing on social media and beyond, and saying we want to be heard. A very unusual type of development in a nation known for cracking down on protests, leaving a lot of people drawing comparisons to the Tiananmen crisis back in 1989. In markets, it is a knee-jerk risk-off field, but that is interesting to me, the fact that you're seeing a stock sell-off and you're also seeing bonds gain, yields lower, this inverse correlation, the 60-40 kind of reasserting itself, the S&P lower by 0.7%. Dollar weakness, that is the one outlier with all of this. Why is the dollar the weakest versus peers? If you look at the DXY index going back to August, we're seeing euro dollar go to 104.62, 10-year yields lower, 3.68%, or excuse me, they've actually shifted higher. Sort of interesting. They started the day lower. They have now shifted slightly higher, about flat. And what we've seen in oil prices is lower as we talk about the potential for more disruption. Coming up in Balance of Power on Bloomberg TV and Radio, Anna Ashton, China Corporate Affairs and U.S. China Director at the Eurasia Group. From New York, this is Bloomberg.